We'll also look at the in-year adjustments in terms of the departments, also look at the adjustments at the provincial and local government equitable shares, and we'll also look at the fiscal risks that we see. We'll also take the House through the public sector wage bill and also look at the medium-term budget policy recommendations in terms of our analysis as the FFC. And then finally, Chairperson, I'll come towards the end with the recommendations. I would like now for the first researcher to take us through the macroeconomic environment and fiscal policy. Over to you, researchers.
Thank you, Chairperson. Next slide, please. So just here, we try to highlight, to give a broad overview of the macroeconomic environment. And I think it is worth noting that our GDP has increased for 2 consecutive quarters, and it increased from 0.4% in the first quarter, and also increased by 0.6% in the second quarter. And we see that from the forecast by National Treasury expects growth to average 1.4% in the medium term. And this is important insofar as it relates to debt stabilization and also insofar as it relates to revenue. But we see that there are some risks because inflation continues to be high, and also interest rates continue to be high, and these affect the borrowing cost or the financing costs that the government face, and also households, including businesses. But we also see that inflation combined with long-term structural challenges will continue to weigh in on South Africa's economic growth. And we also note that there is a need to continue to address or to move faster insofar as addressing structural economic issues that face South Africa to enable growth, because it is important that we achieve that growth in order to stabilize our debt and reduce our deficit. Next slide. And then insofar as fiscal policy, we see that corporate tax collection, especially in the commodity sector, underperformed and weakened the revenue outlook. We see that the expectation is that the consolidated budget deficit is projected to reach 4.9% in 23-24 before it begins to narrow to 3.6 in the outer years of the MTBPS. And then we see that now what has happened, government debt is projected to stabilize at 77.7% of GDP. And what we see in terms of the expenditure side, we see that baseline budgets for education, basic education, health, and police are projected to grow in nominal average annual terms. But we see that the main budget, non-interest expenditure, will decrease by a net of 85 billion. But what we like to highlight is that SOEs continue to require fiscal transfers to cover their losses and to recapitalize their balance sheet, and they continue to pose a risk insofar as the fiscus is concerned, and this may cause fiscal challenges. Next slide. Next slide. Then insofar as the economic prospects, what we see is that the global economy continues to be confronted by low growth and inflation, and we see that the world economy is expected to grow by 3% in 2023 before slowing down to about 2.9% in 2024. And what we see is that a disproportionate share of the global growth between 2023 and 2024 is expected to continue to come from Asia. This is despite the weaker than expected recovery insofar as China is concerned, and also the crisis that they face there in terms of their real estate. So, but we want to also highlight that the short-term global outlook is likely to be shaped by geopolitical tensions which are ensuing, that is the Russia-Ukraine war, and also the new conflict between Israel and Palestine, but also increasingly the visible impact of monetary policy tightening by most central banks and the stresses in the China economy are also likely to shape the global growth in the short term, but a recovery is expected in the outer years of the forecast. Next slide. Inflation remains high and continues to erode the household purchasing power. Although it went down from a peak of 8.7 a year ago in 2022, and it decreased to below 6.8% in 2023. And energy and food prices slowed from their peaks, 2022 peaks, although food prices still remain elevated, and this is likely to affect the poor disproportionately to those that are affluent. But what we like to highlight is that although we anticipate a decrease insofar as inflation as you look into the outer years, geopolitical tensions are likely to disrupt the positive trends that we've seen insofar as decreasing inflation and stabilizing of prices. Next slide. Looking at the domestic economy, what we see is that the domestic economy continues on its slow growth path. This is despite us experiencing a GDP increase for 2 consecutive quarters, which increased by 0.4 in the first quarter and 0.6 in the second quarter. And we see that domestic factors such as the electricity challenges that we face, deteriorating infrastructure, and also other long-term structural challenges, they continue to weigh in on South Africa's growth prospects. And again, we want to emphasize here that the government must move faster in implementing structural reforms to support growth, because without sustainable growth, achieving debt stabilization will necessitate even larger and more harmful spending reductions, which may not be desirable. So we encourage that there is a need to move faster to avoid those larger and harmful spending reductions insofar as government programs are concerned. Next slide. In terms of this slide, what we see is that in August 2023, the annual consumer price inflation stood at 4.8, and in September, it increased to 5.4%. And what this shows is that although inflation had already decreased and gone back into the band that the South African Reserve Bank wants, or the South African Reserve Bank band target, it's still increasing, and this may necessitate some monetary policy tightening. But these, of course, this monetary policy tightening will increase South Africa's debt servicing cost. This is because maturing debt will then be refinanced at higher interest rate. So there is a need for a balance insofar as our policy options as it relates to the fight against inflation. Next slide. And then I think this slide it's merely just showing the unemployment rate, and what we see is that long-standing structural challenges, as we've been saying throughout the presentation, that they continue to impact on South Africa's growth, and they have also undermined the progress in reducing poverty, unemployment, and inequality. And although we see that the official and the expanded unemployment rates have not yet reverted to pre-pandemic levels, the official unemployment rate decreased to 32.6%. And when we look at the expanded unemployment rate, it also decreased to 42.1%. So we note these decreases, but we want to highlight that these long-standing structural issues continue to hinder our ability to grow and our ability to address the issue of unemployment and inequality. Next slide, please. Here, Chair, I will hand over to Thando, who will take us through the next few sets of slides before handing to the other presenters. Thank you.
Thank you, Sianda. Good morning again, Chairperson and honorable members and colleagues who are present on the platform. So with regards to tax proposals, what we we were noting is that the MTBPS introduced new tax measures to generate additional 15 billion in government revenue for the 2014 budget. So despite the previous stance of not increasing taxes further after the COVID-19 pandemic, we see that government has recognized the need to implement these measures. Secondly, what we're noting is that given the challenges in raising taxes, tax policy in our view, should focus on protecting the tax base and implementing reforms that promote fairness, efficiency, predictability, and simplicity. So this entails reviewing the tax regimes for small businesses, potentially broadening the tax base to allow for lower corporate income tax rates, and considering reforms to consumption taxes to promote long-term economic growth. Thirdly, what we are saying is that expanding the property tax base and strengthening wealth is recommended to address wealth inequality, and this can be achieved by intensifying the taxation of donations and estate duties, ensuring that the wealthy contribute proportionally to society. And lastly, what we are saying is that incremental increases in the carbon tax rate and expanding its coverage will benefit the economy in reducing the carbon intensity. So the government can encourage business and individuals to adopt more sustainable practices and contribute to environmental protection by implementing these measures. Next slide. So in terms of revenue outlook, this graph compares the revenue projections of the 2023 budget and the 2023 MTBPS, and we're covering the period between 2023-24 and 2025-26. There are three main points that we want to make with regards to revenue outlook. Firstly, that the revenue outlook for the current fiscal year has worsened significantly, with a deviation of 56.8 billion from the projected budget for 2023. We see also that in the following two fiscal years, tax revenue is expected to be 53.7 billion and 67.6 billion lower than originally anticipated. Secondly, what we are seeing is that VAT revenue has been revised downwards by approximately 25.6 billion for the current fiscal year due to the high cost of living, which has constrained household spending. On the other hand, with regards to personal income tax, we see that it has performed relatively well, and it is expected to slightly suppress expectation for the current fiscal year by around 6.4 billion. However, what we want to bring to the attention of the members is that the outlook for the personal income tax revenue in the medium term is uncertain because of sluggish employment growth. Thirdly, we're saying the current fiscal consolidation strategy has reached its limit and cannot stabilize medium-term debt or meet public service needs. So restructuring the tax benefit system is necessary to create flexibility, finance reform for economic growth, and address the inequalities that continue to characterize our society. So despite resilient tax to GDP ratios, prioritizing economic growth and improving tax administration are crucial for enhancing government revenues. Next slide. So now with regards to fiscal framework, please, can you go a slide backwards? Just, yes. So the first issue that we're addressing is the issue of fiscal framework slippage. So we are making a number of points with regards to that. Firstly, that the fiscal slippage in the 2023 MTBPS results from a lack of a coherent macroeconomic framework and a unified strategic approach to addressing macroeconomic challenges. This has led to fragmented policy decisions not integrated within a comprehensive macroeconomic framework. Secondly, we are saying that the 2023 MTBPS highlights the difficulties faced by the fiscal framework in generating revenue and controlling expenditure. Policy decisions lack the effectiveness and efficiency needed to achieve fiscal consolidation and sustainable economic growth without a comprehensive and integrated framework. And then thirdly, we're saying that the government is dealing with a significant debt redemptions further worsening the fiscal situation. Revenue estimates have been revised downwards by 44.4 billion, while expenditure has increased by 10.3 billion, primarily due to higher debt and higher debt service costs. Consequently, what we see is that the fiscal deficit for the fiscal year 2023-24 is expected to increase to be 330.1 billion, which is equivalent to 4.7% of GDP, which is higher than the projections in the 2023 budget. Lastly, we are saying that the increased deficit, existing obligations for ESCOM debt relief, and the significant debt redemptions will cause government gross debt to reach 74.7% of GDP in 2023-24, surpassing previous estimates. Although gross debt is projected to stabilize by 2025-26, what we see is that the weak fiscal framework in the medium term will lead to a higher debt level of 77.7% of GDP, thus surpassing the earlier anticipated peak in the 2023 budget. Next slide. So this slide, we are addressing the issue of restoring fiscal sustainability. So the slide compares the main government revenue and expenditure between 2023 budget and the 2023 MTBPS for the period 2020-21 to 2026-27. The first point that we want to make is that the fiscal situation is weaker than what was projected in the 2023 budget. This is due to increasing public sector wages, growing debt service costs, and the extension of SRD grants. So what we see is that despite efforts to reduce spending, fiscal sustainability has not been restored. The reduction in frontline services have also been insufficient in addressing the underlying macroeconomic challenges faced by the country, thus hindering the achievement of fiscal consolidation. Secondly, we see that sluggish economic growth and structural inefficiencies, as Sianda was alluding to, further impede fiscal sustainability. Taking a comprehensive approach beyond austerity measures and general reforms is now necessary. So we're saying failing to meet the fiscal targets damages credibility and has far-reaching implications. So we see that it weakens government's ability to restore sustainability and diminishes the effectiveness of fiscal policy as a tool for stability. And then lastly, we're saying the repeated postponement of consolidation measures and increased expenditure estimates indicate a significant deviation from fiscal targets. The effectiveness of spending ceiling is now questionable. Therefore, it is important to implement fiscal rules that enhance fiscal discipline and ensure long-term sustainability. And adopting fiscal rule will establish a clear guidelines and targets for key fiscal indicators, instilling confidence among financial markets and stakeholders in government's commitment to fiscal sustainability. Next slide. So in addressing the issue of debt stabilization, the graph on this slide illustrates the primary balance, which is essentially the difference between government revenue and non-interest expenditure, and debt service costs covering the period 2020-21 to 25-26-27. And we're making two key points with regards to this issue. Firstly, according to the 2023 budget, a small primary surplus was projected for the fiscal year 2022-23. But however, what we see is that this surplus did not materialize as expected due to increasing debt and interest expenses. So an important indicator for predicting the trajectory of South Africa's debt to GDP ratio suggests that the country's debt levels will rise. Secondly, we unpack the issue with regards to debt stabilization. So in order to stabilize debt to GDP, it is necessary to achieve a primary balance that considers the debt ratio and the difference between the average interest rate and the GDP growth. So a primary surplus is required to stabilize debt when the inflation-adjusted interest rate exceeds the growth rate. So for illustration purposes, if we assume that the economy is growing at 1% and inflation is at 3%, a 2% primary surplus is required. But if the growth rate increases to 2%, a 1% surplus would be sufficient. And with a 3% growth rate, a near zero surplus will be required. This is just to highlight the importance of implementing fiscal consolidation measures to achieve and maintain the projected surplus. Next slide. So in terms of recommendations then, with regards to tech policy, we are recommending the reduction of tax allowances and deductions while increasing the taxation of fringe benefits within personal income tax. Secondly, we are recommending a review of all business tax incentives to ensure they effectively achieve their policy objectives. And thirdly, we are recommending gradually decreasing exemption to carbon tax and progressively raise its level. And then lastly, we are saying there is a need to consolidate the small business and macro or business regimes to establish a more progressive tax schedule, promoting fairness and reducing administrative complexities. With regards to sustainable fiscal framework, we are recommending the implementation of fiscal rules that provide a comprehensive framework and impose specific constraints on fiscal policy. Secondly, the establishment of a clear and coherent macroeconomic policy that complements the pro-growth fiscal consolidation strategy. Chairperson, with your permission, may I now hand over to my colleague, Sasha, who will continue with the presentation.
Thanks, Tando. This section, Chairperson and members, covers the 2023 Adjustment Appropriation Bill and also provides some views on spending by a functional category. So net in-year adjustments amount to 10.3 billion in 2023-24, and the need for adjustments is largely prompted by the lower than anticipated revenue, juxtaposed against the need to cover the costs associated with the 2023-24 wage bill agreement, as well as increases in interest costs associated with borrowing. Now, at the time when Budget 2023 was tabled in February, the appropriation bill amounted to 1.077 trillion. Now, to assist with catering for the various in-year spending pressures, the 2023 Adjustment Appropriation Bill records a net downward adjustment amounting to 12.4 billion, which takes the total adjusted appropriation by vote down to 1.065 trillion. Provinces require the greatest assistance to cover the costs associated with the 2023 Public Service Wage Agreement, and as a result, the provincial equitable share is adjusted upward by 18 billion, and this is included as part of the direct charges on the National Revenue Fund. And the money is in respect, of course, of the two most labor-intensive departments at provincial level, namely your provincial education and health departments. 1.6 billion is added to the cooperative governance vote and is aimed at providing assistance for damage caused by floods. And the Commission welcomes financial support to assist with rebuilding damaged infrastructure, and advises that to avoid delays and poor quality, that Parliament should receive regular updates on progress with rebuilding this damaged infrastructure. With respect to rollovers, there are two votes, namely your Home Affairs and Basic Education.
I just want to check. Help.
With respect to rollovers, there are two votes, namely Home Affairs and Basic Education, that are requesting for funds to be rolled over. So rollovers usually result due to slow spending or challenges with spending. And the implication, if we take the example of the Department of Basic Education, is that the department will be, if they are unable to overcome the factors that prompted the need for the rollovers, there will be delays in infrastructure delivery, given that the DBE's request for rollovers relates to the School Infrastructure Backlogs Grant. Part of that rollover is also with respect to learner-teacher support material, specifically workbooks. And given that spending over the medium-term expenditure framework is going to be constrained, particularly for provinces, it's important that inefficiencies that slow down the delivery of key educational inputs are minimized. Next slide, please. Now, much of the 2023 Adjustment Appropriation Bill is about implementing baseline reductions and thus freeing up resources to cover pressures resulting from the wage agreement and interest increases. The table on this slide shows a selection of the 41 votes and how adjustments were implemented. And there were 4 votes that saw quite significant reductions, and these include the human settlements, higher education and training, social development, and basic education votes. Much of the cuts were to conditional grants that fund social infrastructure. So again, the implication is that the impact of these cuts will be felt most at the provincial level, where conditional grant funding to develop your school infrastructure, your housing developments, etc., are utilized. Chair, the reduction to the higher education and training vote will see a 2 billion reduction in the university program, specifically in respect of student loans and bursaries. And the concern is for those needy and deserving students that won't get cover. Lubabalo, the slide before this, please. Yeah. The sector is also confronted by a number of challenges right now, including it with its entity, the National Student Financial Aid Scheme. We've seen reports of money going to students that should not be receiving money or that do not exist, and other issues of mismanagement. So there's an urgent need to, especially now with limited resources, to improve governance and systems within the NSFAS so that it can properly target and vet students in need of assistance. Chair, the other reduction is with respect to the Social Security grants, notably the 1.7 billion cut to the SRD grant. In addition to this, the grant administration funding was cut by 4 million. Now, throughout the short life of this grant, the Commission has continuously raised concern around underspending and cuts to this grant, especially given the cost of living crisis and extent of the need that exists. And we hope that the cuts do not mean more measures to limit eligibility for this grant. On the issue of reductions to grant administration, this has the potential to affect the efficacy of processes underpinning grant application, approvals, as well as payments. And delays in access to grant money can be detrimental to beneficiaries, and therefore the Commission advises that the Department must ensure that mitigation strategies are in place to avoid this. Moving to the next slide. This slide covers consolidated spending by function over the next 3 years, and we see a 4% nominal increase is projected between 2023-24 and 2024-25, so the next financial year. And this will take consolidated spending from 2.3 trillion to 2.4 trillion in 2024-25. As is the aim annually, government tries to maintain a balance between spending on capital to support its infrastructure-led growth approach, and it tries to balance that with spending on social wage interventions. And we thus see the strongest growing functional categories being the economic development category, which is projected to grow by 6.3% in 2024-25. The community development cluster will grow by 5.4%, and that contains your funding for basic service, but delivery of basic services, as well as the local government equitable share allocation. And then social development is set to increase by 4.8% in 2024-25. But of course, the growth in these functional categories competes with the growth in debt service costs. And in 2024-25, debt service costs outgrows the 7 functional categories and is projected to show an 8.8% increase. In 2024-25, health budgets are projected to grow quite marginally by 1.5%, learning and culture by 2%. And if you drill down deeper, into learning and culture, it includes basic education, and that vote is projected to grow marginally as well by about 1%. So very minimal growth in the 2 biggest provincial functions, largely due to the need to cover the wage bill costs. Chair, there are two broad issues we wanted to note. The first, as we've done in previous submissions, is to reiterate the need for certainty regarding the SRD grant and more broadly the reform of social security in South Africa. And what we note is that due to the lack of policy certainty, over the past 3 years, funding for the SRD has occurred in an ad hoc manner, which places much stress on the fiscus and creates uncertainty for beneficiaries. The second issue concerns the infrastructure-led growth approach. And while there is much merit in this approach for kickstarting growth, we need to think about whether this approach is suitable for South Africa, given our challenges with implementing infrastructure projects. Each year, there are new interventions to strengthen our capabilities to manage and implement infrastructure projects. And it's not clear whether these interventions are having the intended outcome. This year, we see the announcement of the establishment of an agency and to assist with crowding in private investment in infrastructure and private sector involvement with infrastructure development. And we caution against the establishment of interventions that have similar mandates. So in the past, we've had the Infrastructure Delivery Improvement Program, which focused on provincial departments, especially health and education. We had the Municipal Infrastructure Support Agency, or MISA, which focuses on infrastructure at the local government level. There's also the Presidential Infrastructure Coordinating Commission. So we would advise government that a more effective approach from both a technical and cost perspective would be to consider options for integrating these various interventions so as to leverage the full complement of skills and experience while also reducing operating costs associated with these interventions. Moving to the next slide, please. There are 3 recommendations emanating from the section. The first is that the nominal growth across most of the functional spending areas are noted. However, if the protection of spending is not accompanied by the delivery of quality services, then these increases will remain a technical budget exercise. Secondly, we call for policy certainty on the way forward with the SRD grant, as the continued extensions disables effective planning within the budget process. Third, we advise that government rethink its infrastructure-led approach to growth and whether this alone can kickstart growth, especially considering our capabilities or deficiencies in capability to manage and implement these types of projects. Moving to the next slide. This section looks at the 2023 Division of Revenue Amendment Bill and focuses first on provinces and then municipalities. So while the total intergovernmental transfers for provinces is projected to increase over the 2024 MTF period, the extent of the growth varies across the 3 years. In 2024-25, we have 2% projected, so a below inflation increase. And over the outer years, we see growth in the region of 4% per annum. As members will be aware, the provincial equitable share allocation is the dominant funding instrument at provincial level. And it's important to note that while the PES is projected to increase, the key driver of the growth in 2024-25 is the need to fund the wage agreement costs. So we're facing a situation where budget increases are not for improvements to service delivery, but rather to assist with covering or absorbing the increased employee costs. Generally, provinces are set to face financial constraints, especially in labor-intensive departments, where that extra funding to offset the wage bill costs exist. Moving to the next slide, please. Provinces, apart from the provincial equitable share allocation, provinces also rely heavily on conditional grants. And conditional grants play a critical role in funding infrastructure development related to key provincial responsibilities, such as basic education, health, and housing. And what we see is that conditional grants are negatively affected by the need to cover wage-related costs, especially in 2023-24, where due to the need for in-year adjustments, a number of conditional grants were cut. And overall, we see provincial conditional grants being reduced from 123 billion in 2022-23 to 121 billion in 2023-24. And with limited own revenue sources, most provinces rely quite heavily on this conditional grant funding, and hence the reduction is likely to negatively affect the ability of provinces to deliver services and infrastructure to poor households across a range of functions, from basic education and healthcare to housing. MTBPS 2023 is also clear that provincial education departments will be constrained in terms of hiring new teachers, and that this may very well lead to larger class sizes and higher learner-teacher ratios. And these are aspects which will also negatively affect learner performance. With respect to social welfare services, which is implemented at the provincial level, MTBPS 2023 indicates that there will be a funding gap in respect of core services and in respect of transfers to non-profit organizations. And the Commission understands the limitations presented by the present fiscal position that the country is in, but given the anticipated funding gaps, it is imperative that provinces find ways to manage the disruptions that limited funding will have on service delivery, so that government is also not exposed to potential litigation. And we say this against the background of the 2010 Nawonga judgment and the more recent Life Isidimeni case. So the point is that cutting funding to implementing agents such as NPOs doesn't absolve government from its constitutional responsibilities. And so national government must work with provinces to come up with strategies to sustainably absorb cuts in key areas. Next slide, please. The main point on this slide, as captured in the third bullet there, is that when we view the growth profile of key sources of provincial revenue, which are projected to show below inflation increases, and we view this against the rising costs associated with the delivery of basic services and the need or demand for those services, the implication is that infrastructure as well as major reforms like the NHI are likely to be negatively affected. Moving to the next slide. There's one recommendation flowing from this section. It relates to the cuts to conditional grants, especially the 2023-24 figures. And we note that these reductions are likely to affect the implementation of key projects. And the Commission recommends that government develop a comprehensive funding plan to ensure that implementation of key projects and programs stay on track for completion. Moving to the next slide, this section covers local government, and we note that the 2023 MTBPS was tabled against the backdrop of a local government sphere that is confronted by various challenges, including numerous municipalities being in a state of distress or dysfunctional. And for the Commission, as we've stated in our annual submission tabled in May this year, there must be a rethink of the local government fiscal framework. And this needs to happen quite urgently and should include the governance and institutional regimes in the sector. Moving to the next slide, please. This slide and the next slide will hone in on the two key intergovernmental transfers to municipalities, namely the Local Government Equitable Share Allocation, or LES, and Local Government Conditional Grants. We start with the LES over the 2024 MTF period. And projections show that the LES is set to grow by 6% in 2024-25, 5% in 2025, and 4% in 2026-27. One of the primary considerations at the local government level is that poor households must be cushioned against the rising cost of free basic services. And this raises the dilemma which exists at the local government level, where on the one hand, it's about protecting and growing allocations in the face of rising costs. And on the other hand, it's also about ensuring that municipalities make efficient and effective use of existing resources. Move into the next slide, please. Overall, local government conditional grants are projected to grow by 7% in 2024-25. 5%.
Sorry, I don't mean to interrupt, and I don't want to be mechanical about this, but Chairperson, can you just guide us? You're at 44 minutes right now. We need some exchange, and we've got the written text, obviously. So how many more minutes will you require? Who else coming after you?
I think that will be the end
Last one.
of slides.
Okay, fine. If you can round up in the next 5 minutes, yeah, if you can round up in the next 5, that will help. Remember, you're coming back because you'll be put questions to, and then you can slide in other issues that you feel are important.
Okay, thanks so much, Chair.
Because they give you extra, then they give PBO extra, but 5 minutes more seems reasonable.
Okay, thanks, Chair.
If anybody disagrees from the committee, they can raise their hand and say, no, let's give them more time. That's fine by me. I'm just merely coordinating. I don't make the decisions. So if people want to raise anything, I don't see any hands up, but you can just come in without even raising hand and say, look, give them a few more minutes or whatever. But 5 minutes for now. Thank you.
I think we can move to the next slide then. I think on the issue of the Eskom debt, municipal debt relief, we as the Commission welcomes the initiative. We do raise concern over the conditions attached to the debt relief as they tend to be punitive. And here we cite the example of the condition for Eskom to take over the electricity provision function from municipalities should they fail to fulfill the debt relief conditions. And given that electricity is the main revenue source for municipalities, it could this punitive approach would have detrimental consequences on municipal sustainability. I won't go through the recommendations emanating from the section, so I'll hand over to Tando, please. If you could move, yeah. Thank you.
No, thank you, Sasha. I'll quickly just run through the fiscal risk as we outline them. So with regards to this particular slide, the only takeaway from the slide is that debt costs continue to crowd out government spending. Let's move to the next slide. And then on this slide, what we're saying is that high interest rates on domestic government loans continue to pressure the fiscals, and thus resulting in higher borrowing costs. Let's move to the next slide. With regards to this slide, we just want to highlight the fact that when considering Eskom debt relief, a primary surplus is only expected to be achieved in 2026-27. This indicates the government's ability to allocate more funds towards debt stabilization, but it is significantly constrained over the medium term. Next slide. So with regards to this slide, what we are saying is that contingent liabilities weaken the economic and fiscal position of the country. It is crucial to maintain this downward trajectory to mitigate the risk associated with government guarantees and restore investor confidence. Next slide. With regards to this slide, we're saying the conversion of Eskom debt relief program to an interest-bearing loan means that Eskom will be obligated to pay interest in addition to repaying the principal amount. But what is important, what is an important takeaway is that the impact, this impact will on the fiscals will depend on the interest rate specified in the loan agreement and the Eskom's ability to service the interest payment on the loan. Next slide. In terms of the recommendation, what we're recommending is that government must aim for a primary surplus to reduce debt burden and restore fiscal sustainability. Next slide. We've done an analysis on public sector wage bill. I won't go through the details of the analysis, but what I just want to highlight is that we can go to next slide. Next slide. In terms of recommendation, what we are recommending is that the cost containment measures should not compromise essential services that the government is providing. With that, and with your permission, Chair, let me hand over to the FFC chairperson to conclude. Thank you.
Thank you so much, Tando. So essentially, members, what we foresee as the Commission is that the economic growth outlook does not look good in terms of what is currently happening in the global economy. We expect to see inflationary pressures and tightening financing conditions. We also expect that our public finances will remain constrained in the context of these rising global tensions. And in light of these, the Commission encourages government to move faster in implementing structural reforms to support growth. Because without sustainable growth, we believe that achieving debt stabilization will necessitate even larger and more harmful spending reductions. Next slide. And finally, in recent months, we've seen that financial conditions have tightened, which points to a worsening of the sovereign risk premium and an increase in the financing cost faced by government. Most importantly, as we consider the ESCOM problem, we believe that performance of that SOE poses a huge risk to the fiscus, as evidenced by the net profit losses, unsustainable debt levels, and worsening liquidity ratios. So the issue of ESCOM should be looked at quite closely. So in light of this, we want to hand over to you, Chairperson, and we'll entertain questions. Thanks.
Thanks. Yeah, as you see from the program, we're taking the PBO and then we'll deal with programs to both of you respectively. So shall we hand over to PBO?
Good morning, Chairperson. Thank you so much.
Good morning. We can, yes, certainly. A bit louder, maybe, if you can raise the volume.
Okay, a bit louder. Okay. I speak softly. Thank you so much.
Okay, there we are.
Chairperson, and good morning to members and colleagues on the platform. Thank you for the opportunity to brief the committee on this regard. I'm with the team on the platform. We are also with the 4 members of our advisory board on this platform. We'll show the faces when the time comes. Since the last time we met, Chairperson, we have 2 new members who joined the team, Ms. Kagiso Mawabolo and Dr. Mukundi Mapangwa, who are also on the platform as well. This is an outline of our presentation, Chairperson, members and colleagues.
We welcome them. Thank you very much for letting us know.
Thank you. Next slide. I think just to emphasize, Chair, members and colleagues, our presentation today will largely focus on the fiscal framework. We will come next week to present on the division of revenue and appropriations as well. But I think the extent of presentation, we focus a lot on proposed fiscal framework and to extent to which it supports help government to really deal with the issues of unemployment, poverty, and inequality, but also whether the proposed approach to fiscal stability will really help secure fiscal future stability and prosperity in the context of these challenges we are facing. We'll also try to examine the policy framework as well as the global and domestic economic issues, which impacts our economic performance as well, and also reflect comments on revenue and some of the issues around expenditure and state-owned entities. I think, Chair and members, to start our presentation, I'll just give a key message as a context of our presentation. And I want to start by really reminding members that the National Planning Commission have recently did a 10-year review on the National Development Plan, where we are, and the report does really shows that we've done quite little progress in really achieving some of these outcomes in the NDP. And I think we're concerned that the MTBPS proposals also do little really to respond to these concerns of the slow progress in realizing NDP outcomes, in particular also looking at the policy priorities that were set out in the State of National Address by the President earlier in the year. Despite government stating that, keeping with the composition of spending broadly in line with the policy, we're concerned that really the policy issues are not really strongly taken into account in this regard. We also know that the government knows that South Africa has one of the largest level of social spending protection, as a percentage of GDP compared to other developing countries. I think here, my concern here is that that comparison doesn't provide a broader context, which really justifies why we need to do more support households, but also need more to transform the economy to ensure that we can create more work. The context, for example, I'm referring to here is when you look at the developmental indicators performance in particular, we see that South Africa has highest unemployment, inequality, and also poverty levels are quite high compared to the similar countries that we compared with in terms of how much we're spending on. And this really shows a need for the importance of justifying use fiscal policy, the budget, to really transform the economy, support households as well. Pursuit of the budget surplus in the current climate, look at the economy, society, and public finances will likely hurt the real economy and really disable government's capacity to really plan long-term, but also deal with the service delivery. And that also has an opportunity, potential to worsen the risk, the debt levels in the medium term. The cost of reducing expenditure on the performance of the economy is too high because we see that by own government admission, we're still far behind realizing our developmental indicators outcomes set out in the NDP. Extraordinary high level of structural unemployment, poverty, inequality, market concerns, so much challenges, financialization of economy, really all these challenges really point out to a really continued underinvestment in the economy and also poor economic performance over the period of time. It's important that we take this into account in planning such as this. A concern that the credibility of the fiscal policy framework remains in question unless really government acknowledges the urgent problems facing our economy and the fact that electricity availability is one of the problems. There are so much issues that really need to be taken into account as the risks impacting our fiscal framework over the medium term. Lastly, Chair and members, really, we like to also emphasize the importance of really learning from the challenges of ESCOM and the experiences should really serve as a lesson that delaying adequate support sending on entities with financial difficulties really exaggerate their future financial promise, which at the end of the day will come back to us and want us to say we should have done this. And that should be a lesson for many other SOEs. Chair, within those open remarks, I want to give it to Dr. Mapula to take us through the policy priorities and really reflect on how the budget does reflect on those. And thanks so much. I'll come in later to just say thank you. Dr. Mapula.
Good morning, honourable members. It's going to be me that's going to present the policy priorities. Next slide, please.
Thank you, Nelia. Thank you so much. Thanks.
Members, this slide provides summaries of the 2023 State of the Nation Address, budget, and now the amended medium-term fiscal strategy. In SONA, the President announced that government is not presenting new plans. The objectives of the 2023 budget was to reduce the budget deficit, support economic growth by directing resources towards infrastructure, and to reduce fiscal and economic risks. Key elements of the medium-term fiscal strategy is to continue with stabilizing debt, reconfiguring the structure and size of the state, but no big announcements were made except for the merging of a few public entities in this MTBPS. It also aims to, but it also says that it will protect critical frontline services, and the composition of spending will be kept broadly in line with existing policies. Next slide. So members, as you know, the National Development Plan introduced in 2013 remains the country's blueprint to grow the economy, reduce the unemployment rate, increase gross fixed capital formation, reduce inequality, and to totally eradicate poverty. 10 years later, the government must admit that it is unlikely to achieve any of these goals and that conditions have worsened in certain instances. Next slide. So the table shows the progress with the implementation of the NDP. In terms of the targets to reduce the proportion of households with monthly income of below the poverty line from 39% to 0%, the latest information in 2017-18 shows that 64% of blacks, 41% of colored, 6% of Indians, and 1% of white South Africans were living in poverty. In terms of the target to increase employment to 24 million in 2030, The current number shows that 16.3 million is currently employed. In terms of the increasing the quality of education so that all children in grade 3 can read and write, the 2016 progress in international reading literacy showed that 78% of children had not learned to read with effective comprehension by the time they reached grade 4. And in 2021, it has deteriorated to 81%. In terms of the target for public infrastructure investment to reach 10% of GDP, at this stage we've reached, it is less than 2% in the current budget. Next slide. So how does the 2023 MTBPS respond to the NDP targets that we haven't reached or that we still estimate to reach by 2030 in terms of learning and culture? Provincial education departments are constrained in hiring additional teachers, which could lead to larger class sizes and higher learner-teacher ratios, possibly resulting in weaker education outcomes. In terms of health, to minimize negative effects, the sector needs to improve efficiency in areas such as overtime payments, medical supplies, and security services, and to also delay infrastructure projects. And to also improve efficiency, the structure of the conditional grants will be reviewed. On the social development function, the social grants baseline includes inflation-linked increases in 2024, 25 and 25-26, but provincial budget allocations will not increase in line with inflation, leading to a funding gap for core services and transfers to non-profit organizations. The sector needs to prioritize and realign resources to avoid adverse effects on service delivery. In terms of community development, urgent intervention is required in the urban water business in metropolitan municipalities. Next slide. In terms of the economic function, I've mentioned in this function, the merging of public entities is suggested to improve efficiency. In terms of peace and security, the focus is on improving efficiency and reprioritizing funds towards key programs. And this is also basically the focus of the medium-term fiscal strategy of government to reduce expenditure. Next slide. Members, in terms of the proportions of consolidated spending per function group, you can see the decrease in the proportion spent on learning and culture from the current 20.6% to 19.9% in 26-27. This is also relevant for health and peace and security. And then the proportions to economic development is estimated to increase from 10.6% in 23 to 11.1% in 26-27. It is also very visible that debt service cost increases to 17.6% in 2026-27 from 11.8% in 2021. Next slide, please. In terms of the proportions of the consolidated spending in the economy, the proportions of compensation of employees is still estimated to decline over the MTBPS. Transfers and subsidies are estimated to decline to 31.6% in 26-27, but the detail of this will be shown in the expenditure part of the presentation. Payment for capital assets is estimated to increase to 5.8% of consolidated expenditure. Thank you. We can go to the next presenter.
Okay, thank you very much, Nelia. Honorable members, Honorable Chair. Thank you very much for this opportunity. I just want to say before I go through the slides that we did quite a comprehensive account of things like the global outlook, the economic situation for households and firms in South Africa, and other aspects within our pre-MTBPS briefings that should have been sent to all members of the committees. So I think for background, a lot of the things we're saying here glosses over a lot of the more detail given in those pre-MTBPS things. Just to say, we're starting off saying that the fiscal policy framework has significant socioeconomic and political economy implications beyond the 23 MTBPS proposals. So chapter 1 says, is titled Staying the Course of the 23 MTBPS, staying the course for growth and sound public finances. However, given government's failure to reach the NDP targets, as just mentioned by Nelia, and also seeing a decade of failure with fiscal consolidation to reduce debt and debt levels, it shows that government has to do more for growth and sound public finances, and basically saying that we can't stay this course. We're driving ourselves into lower growth and higher debt. The fiscal policy framework should be more than just a mechanical calculation of how the government determines its level of expenditure and debt based on the size of expected revenue. And these shouldn't be the targets. These should be the tools to drive economic growth, to drive employment creation and development in the economy. And these shouldn't be what the focus of our fiscal framework policy are. These should be looked at as intermediate targets for all, rather than what the goals of policy. And just to note that the fiscal policy framework has significant socioeconomic and political economic implications. Your choice of fiscal policy over the past decade has failed to support the developmental role for the state. It has failed to support economic and industrial transformation. It's failed to reduce inequality through the redistribution of income and improving living conditions. The PBO shows that the National Treasury has to do more. The 2023 MTBPS argues that they say they're protecting the social wage and ensuring national development. And what we're saying is that what we'll show later in this presentation is that the social wage in real per capita terms actually declines, so it's not being protected. We see that national development is not also being protected, is not being supported, and contrary to what's said in the 2023 MTBPS, it doesn't rely on reducing debt service costs. That's a very strange economic perspective for me, and I'll come to that in the next slide. While load shedding has constrained the South Africa's economy, the international evidence and experience has shown that fiscal consolidation has led to permanent reductions in GDP and higher debt levels, even in countries that did not have load shedding. So to see load shedding as the major problem in the economy, and to then say that the reason why the economy is performing poorly is because of load shedding, I think gives a fairly superficial and maybe even short-term perspective on the South African economy, contrary to the view that the poor growth has to be solved with microeconomic policies alone, which is the view coming out of the Treasury and unfortunately much of government as well. The fiscal policy has had huge long-term impacts on growth. By ignoring this fact, these policies may have severely contributed to poor economic growth and larger debt and debt service costs as percentages of GDP. Next slide, please. Now, I just put up these quotes as a way to show that the views I'm stating aren't only the views of economists who don't agree with the mainstream and neoclassical economics or neoliberal macroeconomics, whatever you want to call it. I mean, these are from Fattas and Summers, where Larry Summers was the secretary to the US Treasury for President Clinton, the director for the National Economic Council for President Obama, and he was the president of Harvard University from 2001 to 6. And in the Fattas and Summers study, they found that attempts to reduce debt via fiscal consolidation have very likely resulted in a higher debt to GDP ratios. And they say as GDP falls permanently, attempts to reduce debt via reductions in spending or increases in taxes lead to a higher debt to GDP ratios. There are two IMF working papers that deal with this issue, one by the very famous macroeconomist, and I think many of us have used his textbook in our macro courses, Olivier Blanchard, where he shows in advanced economies, stronger planned fiscal consolidation has been associated with the lower growth than expected. Another study that included their methodology that looked at developing countries, they say that in advanced and emerging market economies may thus be the economic fiscal consolidation's effects on economic activity are similar, more similar than typically assumes, and this is the point, the effects are contractual in both cases. So National Treasury and other people who like to throw around fairly loosely, I must say, economic terms often talk about crowding out and saying this crowds out that. I think in that spirit of loose terminology, I'm going to say that fiscal consolidation has crowded out economic growth, and it's actually led to, over the last decade, for us to have higher debt to GDP ratios. Next slide, please. So the question is, using the terminology from the 2023 MTBPS, is what course are we staying on? We see that the 2023 MTBPS is silent about a path to growth and reducing unemployment. We see that GDP growth is expected to be fairly low over the MTF. The 2023 MTBPS, they said the most urgent problem facing the economy is inadequate electricity supply. And so here we give an example of an urgent problem facing the economy, and we say the PBO reminds members that 1 out of every 5 children younger than 5, it's actually more than 1 out of every 5, suffers from stunting because of poverty and acute malnutrition in South Africa. In our view, government must prioritize addressing this and other sufferings in society as well. And so, as an example, I mean, we all know that the impacts of stunting, and if you think about economies and society as affected by path-dependent things, once a child is stunted, it affects their development, their education, their futures, basically. So every single year, we're putting out over 20% of our children under 5 are becoming the next generation of people that are going to be affected by stunting, and their productivity, their futures are affected by that. So for me, I see that also as probably one of the most important issues in the economy. And since 94, we haven't actually managed to seriously deal with it. It's come down a bit from 94, but not adequately. The PBO has stressed the existence of a number of domestic and international interrelated risks and crises, labeled the polycrisis by the World Economic Forum. We are concerned that the credibility of the proposed fiscal policy framework remains in doubt unless the National Treasury addresses the urgent problems facing the economy, and that electricity availability is but one of these urgent problems. So to just sort of the kind of risk that they're talking about, the MTBPS, we feel is inadequate, and that we're going to end up having to spend money on disasters linked to global climate change, the downward impact on South Africa's and global growth of geopolitical problems, the possibilities of future epidemics and pandemics, etc. We also argue that energy and logistic reforms are necessary but not sufficient for the structural economic transformation required for sustainable economic development and growth, and to tackle structural unemployment in the country. Next slide, please. So the big question, and year after year, we've been asking these questions: where will growth and employment come from? So we did this graph in response to figure 1.4 in the 2023 MTBPS, which basically just give the figures shown in the green bubbles. In South Africa, we see that social assistance spending as a percentage of GDP is 4.6%. In Chile, is 3.5%. In Indonesia, it's as low as 0.5%. And we say that we note that South Africa is one of the largest levels of social protection expenditure as percentage of GDP when compared to other developing countries, but that's said without comparing other developmental indicators. So we've included here unemployment, poverty, and inequality. And we say when considering the context of how much larger unemployment, poverty, and inequality in South Africa is than in other countries, one can understand the case for more social security spending in South Africa. South Africa not only has the highest rates of unemployment and inequality in the world, our rates are so high, we are a statistical outlier. And by looking at this graph, you can see that. And if you look at unemployment in South Africa, it's over 30%. And the rest of those countries that were chosen for the comparison of social assistance spending as a percentage of GDP, we see they all less than 10%. Structural unemployment means South Africa is unable to provide jobs for millions of people who want to work, and the obscene level of inequality is negative for growth and political and socioeconomic stability. There's a large development economics literature that shows that your GDP is constrained when you have high inequality. Next slide, please. Looking at the social wage in rands, and this relates to the point that there's a claim in the 2023 MTBPS based on nominal numbers that the social wage is being protected. What we show here is when you take into account inflation and population growth, we see a decline in what the National Treasury defines as the social wage. And while the social wage is 61% of expenditure, at 61% of declining total expenditure. And the social wage in 2023 MTBPS is not protected from inflation and population growth. Next slide, please. So to sort of come to the end, the question then is with regard to our people and our firms, small businesses, large business and others, thinking about the role of fiscal policy and growth and raising the question, where will growth and employment come from? We say that the support for economic development in the 2023 MTBPS is limited because increases in infrastructure expenditure are offset by declining shares of other items in the economic development function. So earlier, my colleague Nelia showed that one of the areas few areas we actually had growth in expenditure was in social expenditure, but this graph shows that a lot of that, if you look at the bottom square in these columns, is economic regulation and infrastructure. So basically, the expenditure on infrastructure is going up by it's 9.3%, but the rest of those things, so look at agriculture, rural development, innovation, science and technology, industrialization and exports, job creation, and labor phase are all reducing, and that money is being reallocated towards infrastructure. And so we're not really going to see the ability to use things like industrial policy, rural development plans, job creation, growing in line with the needs of the country. We see in the 2023 MTBPS expects real household consumption to grow to reduce from 2.5% to 0.8% in 2023. We saw that in the first quarter of 2023, banks rejected 70% of credit applications, reflecting concerns with household ability to repay. So we are seeing that there's a limitation and a constraint on household consumption. The economic health, even of the relatively affluent households that can go to the banks and use credit cards, is also being constrained. And we have to remember that household consumption is over 60% of GDP. And for that to grow, government needs to be supporting the less affluent people, those struggling with their ability to increase their demand and to support growth and growth of the economy through providing that money that can be spent into the economy. Extension of credit to the private sector as a percentage of GDP has been around 70% of GDP over the last decade. However, private business investment has remained relatively low, from 46% of GDP of the period, which indicates that most of the credit extended to the private sector does not go towards investment and particularly to productive investment in South Africa. So one of the problems is, and these issues are raised much more in our pre-MTBPS discussion, briefings discussion, when managerial decisions focus on maximizing short-term returns rather than support the relative slow growth of productive job-creating enterprises, it is more likely that finance will be misallocated away from productive economic sectors. So just to repeat in ending off on the slide, is that we do not see the 2023 MTBPS supporting households and firms for growth in the economy. And in fact, we argue that fiscal consolidation will lead to further constraints on growth and then cause through that the debt to GDP ratios to increase. Next slide, please. Okay, my colleague will take over from here. Thank you very much.
Thank you, Siraj. Chairperson, honorable members, I'll briefly speak to the slides on the revised fiscal framework and hopefully illustrate why the current proposed fiscal framework is not credible and sustainable. So the graphs in front of you show all the elements of the main budget fiscal framework, and we simply compare the 2023 MTBPS to the February budget. So in terms of revenue, downward adjustments have been effected to reflect the lower than expected corporate income taxes, as well as higher VAT refunds. On the expenditure side, slightly upwards adjustments have been made specifically for the 2023-2024 fiscal year. And in our view, this is to reflect National Treasury's unrealistic assumptions, projections for compensation of employees that were made during the February budget. Moreover, the expenditure or slightly higher expenditure in 2023-24 caters for higher debt service costs amid higher interest rates. Over the medium term, both revenue and expenditure will ultimately reduce, and this is in line with National Treasury's consolidation plans. Treasury also hopes to realize a primary budget surplus in the current year and over the medium term, and we've asked on several occasions at what cost does this primary surplus come at. Next slide, please. So over the medium term, National Treasury's fiscal strategy is ultimately predicated on this idea that you can achieve fiscal sustainability by ultimately reducing the budget deficit and stabilizing the debt to GDP ratio. However, when you look at the graph on your right, it illustrates that debt to GDP ratios and the budget deficits have in fact increased despite Treasury's commitment to fiscal consolidation as a tool for budget management since 2012. We argue that the pursuit of a budget surplus, especially in the current economic environment, would likely hurt the real economy, will erode the state's capacity to deliver services, but most importantly, it also risks higher debt levels. In addition, the proposed fiscal framework will not be able to absorb the risks beyond those National Treasury has classified as fiscal risks in Annexure A of the MTBPS. And therefore, as the PBO, we caution that there are certainly huge costs associated with the very high levels of unemployment, poverty, and inequality, the insufficient resilience of households to respond to domestic, social, and political shocks, climate change events, as we've seen in parts of the country and over the past few years, the long-lasting impacts of COVID-19 and possible future pandemics, likewise geopolitical conflicts, as well as overall economic and financial instability. These outlined risks not only undermine the credibility of the fiscal framework, but also threaten democratic institutions. Next slide, please. Chairperson, in the interest of evidence-based policymaking, we request that National Treasury furnishes this committee with evidence that austerity measures such as fiscal consolidation and the introduction of fiscal anchors will indeed lead to fiscal sustainability and grow the economy. We've seen that the presumption that reducing the debt to GDP ratio through fiscal consolidation will lead to investment, that reality has not materialized. In addition, the structural reforms that are proposed by National Treasury that mainly focus on the network industries will not transform the structure of the economy, but rather favor mega corporations and financial institutions that are rather focused on short-term returns rather than investing in more long-term investment in job creation and economic growth. Honorable members, a narrow focus on budgetary-related variables such as the deficit and debt causes government to miss a very important role it could be playing in terms of addressing or reducing unemployment, poverty, and inequality, the role it could be playing in terms of improving people's lives, the provision of services and infrastructure, while supporting demand-driven economic growth that ultimately builds productivity, economic growth, and financial stability. Chairperson, as I conclude, I think it's important to recognize that the private sector cannot be solely relied upon for the provision of basic public services, and therefore the budget ought to support building state capacity to empower a developmental state that will ultimately address key socio-economic problems in the economy, but also help support structural economic transformation. Honorable members, we are of the view that ultimately in the long run, debt reduction and fiscal sustainability may only be achieved only through pro-growth demand and supply measures that ultimately build the resilience of households and the productivity of businesses, specifically small and medium enterprises. Thank you. I'll hand over to my colleague Lucy to take us through the next section.
Good morning. Next slide, please. In this slide, we show the summary of the in-year amendments. As the FFC has already noted, that the budget increases by 10.3 billion for 2023-24. In this slide, we highlight some areas that members should pay attention to. For example, debt service costs increased by 14 billion. And also we note here the Land and Agricultural Development Bank of South Africa gets or has further 502 million. Other things to note are the declared unspent funds. The PBO, as you know, has done quite a lot of work on underspending. So we take this as an interesting part of our analysis. So 1.9 billion in declared unspent funds. And of course, the wage agreement at 6 billion, which of course National Treasury acknowledges that they hadn't put those increases into the budget previously. Next slide, please. In this slide, we're basically showing where there's been upward or downward adjustments. Important to note that those areas or the votes that are highlighted in blue is where there is actually an increase in allocation, whereas there's a decrease in other areas. Most important is that they're the largest reductions in human settlements and cooperative governance. Before the adjustments budget, 50.6% of the main appropriation had already been spent between April and September 2023. However, with the adjustments, we actually have a higher ratio in terms of spending, which is 51.2% between April and September. This is because there's a 12.4 billion reduction in the budget in total adjustments. Next slide, please. In this slide, we are showing here that national departments grow by 2.3% in the medium term, or between 2023-24 and 26-27, provinces by 3.6%, local government by 4.4%. These notably are all below inflation. So if you look at CPI inflation, that is on average 4.7%. And then if you look at GDP inflation, that's 4.5%. So either way that you measure it against, all these increases or supposed increases are actually in real terms declines. We note here that the increase in provincial equitable share might not be sufficient to cover the implementation of the public sector wage agreement, which is a continuous issue in terms of the credibility of our budget. Next slide, please. In this slide, we're just highlighting, as we always have, that there's an attempt to increase the proportion of non-interest spending to local government. However, we continuously fall below what has been anticipated. So here we see that in the medium-term estimates, there's an increase in provincial allocations. However, as we've already noted, this has not materialized to the greatest extent. But not only that, there's a reduction in conditional grants and programs that are supposedly underspending. Next slide, please. In this slide, we show the real per capita spending by function group. So total per capita expenditure declines in the medium term. We'll be spending less in 2025-26 than we did in 2016-27 per person in South Africa. This is also because the population statistics are higher than what was previously expected. As we know, the census said there are now 62 million South Africans as of 2022. And so you'll see sharper declines here in terms of per capita. Not only with that, but also the budget cuts themselves. The current spend for 2023-24 per person is lower than both the MTBPS 2022 and lower than the budget 23 projection. We also emphasize continuously that fiscal consolidation means real per capita declines in health, education, and other critical sectors that are important to basic survival. Also to note on this graph that the only element that actually increases, or rather function that actually increases, is economic development. Even though community development increases in nominal terms, we do not see real significant increases in terms of real per capita. Next slide, please. In this slide, again, here we're showing that current payments, of course, are increasing, and here it's driven by interest and rent on land, and not the compensation of employees. As we know, there's the policy stance is to reduce the COE. We also note here that the transfers to households get smaller, but that's because, of course, in the outer years, we have not budgeted for the SRD grant, but notably department agencies and accounts, public corporations and private enterprises, as well as nonprofit institutions see a real reduction change between 2023-24, and those are highlighted in red for members to see. Next slide, please. Here, we've also done a real per capita spending analysis by economic classification. What the numbers show is that there is an increase in terms of real per capita spending in terms of economic classifications. However, the numbers are not sufficient to meet the developmental needs for South Africa. So you'll see that there's only 1,000 Rand increase between 2016-17 and 2026-27. And again, we're also noting here the transfers to households declining. Next slide, please. Now I'll go through our government revenue. Next slide. So here we note National Treasury notes that the economy is not able to generate enough revenue. We've included an additional slide which basically shows the comparison between the budgets, the MTBPS, and the outcomes. And so currently we know that the revenue has been adjusted downward for this year, but this is not an anomaly. Historically, Treasury has adjusted downwards in the MTBPS in terms of revenue figures, and actually generally the outcomes tend to be lower. So there's also that trend that we need to be aware of. But we always maintain as the PBO that tax remains an important tool for redistribution, and that the tax base itself reflects the high levels of unemployment, poverty, and inequality in our economy. So actually resolving the economy itself is fundamental in changing how our tax base looks, and that we need more resources to meet the developmental needs for South Africa. And that includes more revenue resources to actually reduce the deficits and the debt itself. Next slide, please. In this slide, we're basically showing that obviously the projections are lower. As the FFC has already noted, this is because there were lower collections in corporate income tax and VAT. And so in this regard, you know, the lower tax revenue and the high expenditure have contributed to a higher budget deficit. And obviously means that we're not going to meet the surplus that had been announced in the earlier in budget 2023. Next slide, please. And this slide, and this will be my last slide, is basically saying, are there additional resources to increase tax revenue? And so considerations for the 2024 budget, as we've said multiple times, that South Africa has got a relatively broad tax base compared to the most middle income countries. And so there are avenues in which you can increase revenue, but also not just looking at tax as just a revenue generating mechanism, but looking at tax as an instrument to redirect production and inputs. So tax can be used effectively as a growth mechanism in of itself. And that we acknowledge the significant reforms that have been implemented in SARS to increase tax revenue collection. Of course, capacity building is always needed, but to acknowledge the work that SARS has done. And here we list some of the areas that could be looked at for the 2024 budget, or the proposals that could be made in terms of tax. And these include progressive measures to tax wealth. These include taxing excess profits from the interest rate hikes, particularly in the financial sector, tackling illicit financial flows with a broader framework than what has been adopted by the base erosion and profit shifting framework, and so forth. And so members can look at that. I'll hand over to my next colleague. Next slide, please.
The debt maturity levels of the largest SOEs decreases over time in the next 10 to 20 years with government guarantee.
You're sounding a bit like you're in a basement. Are you speaking into the mic, please?
Yes, I am.
Okay, go ahead,
You're a
please.
bit low there, Mukundi.
Apologies for that. On this slide, the debt maturity profile of PSOEs is shown that over the next 10 to 20 years, it decreases over time. However, we do see that guarantees to SOEs is also decreasing from 543.6 billion to 448.1 billion, mainly due to changes with the Reserve Bank loan guarantee that decreased from 100 to 20 billion. However, SOEs continue to face a number of challenges, including reduced capital investment, heavy tax burden. All these issues have real economic implications for households and businesses. Next slide, please. So basically, all these changes, there's a need for, there's a role for SOEs to play in the development agenda of the country. You will note that Schedule 2 SOEs are required to operate as self-sustaining, profit-generating businesses that borrow based on the strength of their balance sheet. However, as indicated already, they are facing a number of challenges. So this then raises an important question, particularly in the negative implications of the austerity mindset on broader socioeconomic outcomes. Should the terms credible and stable be applicable to fiscal policy, which is biased towards achieving a primary surplus in the medium term, even though there are huge fiscal risks due to not enough resources being allocated to SOEs? The experience of ESCOM shows that should ESCOM been supported, provided with targeted and conditional support earlier on, load shedding would not have reached the stage it is. So we are asking, why can't other SOEs also enjoy the similar support? So basically, should the PFMA requirement that SOEs, specifically Schedule 2, operate as profit-generating business that borrow on the strength of their balance sheet, given the number of challenges that are having, that they are experiencing, and the poor performance for the country as well as the implications for society. Next slide, please. On this slide, we talk about the triple Ps, which is a strategy that for infrastructure delivery that primarily depends on private sector investment. National Treasury also prioritizes infrastructure investment. However, the MTBPS proposes 4% average annual MTF growth reductions in capital assets compared to the budget that was presented earlier on. So triple Ps remain a highly contested vehicle for infrastructure financing and delivery because of the high costs involved, rigidity of contracts, length of contracts, difficulty in attracting enough private investor interest. So all these issues have been cited by a number of critics over the time. So evidence then suggests that when we're dealing with triple Ps, we should approach it cautiously for individual projects as well as a part of an increasingly integrated pathway to infrastructure delivery or service delivery. Thank you very much.
Thank you, Chairperson and members. I think we'll stop here. We'll wait for further discussions. Thank you so much for the opportunity. Thanks, colleagues.
Thank you, Dumisani. You actually were 44 minutes. It's the best in terms of managing time. I can't help but congratulate you. But really, yeah, no, it's a very good input, actually. Remember, we have the text, and we just like getting into the process, and we will, over the public hearings and so on, imbibe more of what you and the FFC said. So on behalf of the committees, I thank both of you, FFC and PBO. Now over to members. Do I see hands up? Not yet. Nobody's got anything to ask yet. Oh, there's Oscar. Who else? There's Moletsane, Dion, Dennis, Willie, for now, and then Lubabalo, you'll help me to pick up. There's Kolisile, then there's Imzwanele. Right, there we are. Okay, good. Over then to in order you speak, please, there's no need for me to keep coming in. You will say what you want to say, and the next person will take over. In that order, Oscar.
Thank you very much, Chair. Good morning to you, other chairs, and all members on the platform, guests in the media. Chair, I just have a few clarity-seeking questions, but before I pose them, I will want to appreciate the presentations that is made by the teams as led by Dr. Mbava and Dr. Janchis. Chair, the first one is just on tax proposals. In the 2021 tax proposals, corporate income tax was reduced from 28% to 27%. My question is, has there been any study that was conducted to see if this move, which was implemented from last year, had any positive sentiment towards the business in terms of their outlook in the country's investment status, and particularly economic growth? I note the slide 19 by PBO, which says that the credit advanced is advanced to the private sector, but the private sector in return does not invest in the economy of the country. My question is specifically on the tax proposal where their income tax was reduced. Chair, the second point, it's also on the issue of the tax proposals. Now, we see that there are new tax measures that are aimed at raising about 15 billion. That is on the slide 14 from the FFC. My question is, will the FFC arrive at an opinion that a thoroughgoing tax regime assessment and review was conducted to see if there are additional spaces to adjust certain special tax dispensations for corporate income tax, particularly if you consider the special tax regimes that are available for the mining and long-term insurance companies? So in my view, the recommendation that they made to review the tax regime or some of the tax regimes that are available, I support that recommendation, Chair. This one, it's for both the FFC and the PBO.
Sorry, I don't mean to be rude, but can you round up, because otherwise others won't get enough chance. So 4 minutes, I think, should be reasonable. Is that agreeable to the committees? 3 to 4 minutes. You can come back, for the second round if there's space. But if you can kindly round up, thank you.
Okay, not a problem, Chair. My apologies. We were not given.
No, it's fine. I didn't suggest it. Yeah, I mean, I just think we can come back to you. But go ahead for another minute. Okay.
Thank you. On the slide by also the FFC, and then this one can be taken by both. I will let this be my last question, Chair, even though I had 3 more, but I'll pause after this one.
You can ask them quickly, yeah? You can ask them quickly, and then we'll
round up. Problem. Thank you. On the division of revenue bill to provinces, a 2 billion reduction is proposed from conditional grants in order to fund public service wage agreements and debt service costs, something that we really appreciate, especially when it deals with issues of the workers. I just want to find out if is there any additional information that was picked up in terms of how is this 2 billion likely to affect service delivery programs as well as current programs that were beneficiaries from this particular grants. The second last one is on the issue of the policy framework slide number 10 by the PBO under economic development, where it states that government will spend an average of 247 billion to enable inclusive economic growth and job creation. My question is there alignment with the spending to the ERRP, and if there are the specific sectors, noting the 6 key priorities expenditure areas, are the sectors that this will be channeled to? My take would be that agriculture and SMMs should be prioritized as they present high absorption employment rates as compared to many other sectors. The last point is just on the issue of the reduced revenue. I see we cite a reduction in the commodity revenue as one of the reasons. Can either FFC or PBO pick it up in terms of why would we have considered commodity revenue when in last year's budget speech, the minister did say that it was a surprise windfall, and we all know that it was caused by the Europe and the Russian and Ukraine war. And he went go on to say that one swallow does not make a summer. So my question is, why would we cite it as a reason that we see reduced revenue? Because we were warned that we cannot plan our permanent expenditure outlook based on something that we do not know how long it will last. I will pause there, Chair. Thank you very much for giving us the opportunity.
Can I just remind you, there are 8 speakers on the agenda at the moment. That's 8 times 4, that takes you to 32 minutes. We also have to give the stakeholders a chance to reply. What I suggest is maybe people can also put questions in writing, and Lubalo can forward it and we get it back, responses within 48 hours. But is 4 minutes okay, or do people have more time? We have to finish at 12, unfortunately. Some of us have other meetings, and there are people who've got to leave Acacia Park and the other sites. So 4 minutes, I think, for now, and let's see how things go. Is that okay?
It's okay, Chair.
Chair.
Okay.
Okay, Chair. Okay, thanks, Dr. So can we go for it, Mr. Moletsane?
Thank you, Chairperson.
Let me first apologize for not switching on my video due to a very weak network where I am now. Firstly, let me join the colleague to acknowledge both the presentations. And I've got only one clarity question that I want to pose to both the FFC and the PBO. Knowing that it is part of their responsibility to advise Treasury on the issue of the equitable share, have they ever advised the Treasury to revisit the model that they are using to allocate funds to the three spheres of government? That maybe they should start thinking about changing it when looking at how much percentage is given to local government, and looking at the state of many municipalities that are struggling to raise their own revenue. Thank you, Chairperson, for now.
Simon, you are always so much to the point, direct and precise. Thank you for that. The next speaker, you know the order. I think it's Dion.
Thanks very much, Chair. Thanks for your presentations. Well, I won't go into the detail of it given time, but you know, this really is a manifestation of economic policy gone horribly wrong and our economy in a really bad place. But anyway, be that as it may, I really have two questions. The first one is around tax increases. Now, it's very clear that government plans to increase taxes. And there has been a presentation here on where the taxes could be increased. Of course, we would never support those. But anyway, nonetheless, I want to know whether you've had a look at whether there would be any possibility or space for a VAT increase or an increase in personal tax, so pay-as-you-earn tax, for example. Obviously, people cannot afford to pay that, but have you actually looked at that, given that the very dire situation into which we have been plunged? And then my second question and final question is to the PBO. I'm absolutely astounded that you would think that the state-owned enterprises would be able to actually be viable and actually add to our economy, because they are simply not. They are draining us of billions of rands. So I'm actually speechless in seeing that you think that they can somehow be adding value in the state that they're in. So what I'd like to know from the PBO is what about private-public partnerships? Because clearly the model isn't working. And if you think it is working, I'd be very interested to know how you reached that conclusion. Thank you.
Yeah, Dion. Next, is Dennis.
Thank you very much, Chair. Yeah, thanks for the time that was put into the presentation preparation. Again, I will focus on provincial and municipal issues mostly, although my questions were horribly misrepresented by Treasury at our last engagement. We'll try again today. So, yeah, perhaps before I get into the province's issues, picking up on what Dr. George said, and there was a comment that inflation impact is going to affect the poor the most, and there is this concern around raising taxes and possibly VAT. There have, of course, been suggestions that more food items, particularly basic items for people, need to be zero rated. Has PBO or FFC done any work on that and got any thoughts? Obviously, it is already something being discussed, so I would expect that some thoughts have gone into that already. Yeah, then the big issue around the provincial allocations. I did ask the question the other day about the large increase in equitable share going to the provinces, and I asked a question on last week asking whether that was for salary increases or if there was any space for service delivery coming out of those increases. The reality is, subsequent to that, in spite of the dismal answer I got from Treasury, we've done some homework, and obviously with the numbers that I have access to, the Western Cape government needs an additional 2.9 billion rand to fund the salary increase that has been granted to public workers. But the increase is actually only 1.7 billion. So while we're seeing a massive increase in the equitable share, there's not enough going there, and actually service delivery is going to suffer by a further 1.2 billion rand in the Western Cape. Having a quick look at Gauteng is getting 3.7 billion extra, but they need 4.5 to cover their salary bill. So yeah, perhaps if we can get some comment about the crowding out of service delivery by the increased wage bill, it would be much appreciated. Then the local government squeeze. Obviously, equitable share for local government remained absolutely static, but there are areas elsewhere where grant funding has been reduced substantially, but also grants are being taken away from direct to indirect grants as well, and the impact on infrastructure as a result, because a lot of that comes out of MIG, RBIG, and of course the development grant funding, the urban development grant funding, which doesn't show a response to the water crisis. And I mean, can perhaps PBO or FFC point me to where government is responding positively on the water crisis? Then another thing that's happened subsequent to the budget already, we've seen that growth in collections have already been shown to be overly optimistic, and our deficit might be worse than has been projected, even in the adjustment. Perhaps we can have a comment on that. Again, no comment on, although there was a comment about the risk premium and the cost of financing, no comment on grey listing or the movements on grey listing and any positive or negative movements there. And then just equally with Dr. George, my flabber was indeed gasted by some of the comments. And I think it's important, Dr. Mohammed and Mr. Molloy, to state that criticizing consolidation would be much more likely to cause deeper engagement in an economy that wasn't dominated by a kleptocratic government.
Dennis, you're at 4 minutes.
In our elections. Thank you.
Are you done? Oh, thanks. Okay, thank you. I won't comment on the color of your tie and your leadership's response. Who's next? Kolisile?
Yes, thank you very much, Honorable Chair, and thank you very much for the presentation which has been made by both the PBO and the FFC. Chair, maybe one question will be, the same as previous questions. I think it's very advisable that, we get a proper advice as MPs, especially with regard to issues of policy, because they are very critical in enabling us to take a proper decision as MPs. I'm saying this because we have been discussing the issues of growth and fiscal consolidation over past years. And then now I always ask myself and do not get very clear question, how does fiscal consolidation enables GDP growth? Maybe I need to be answered like a grade R people to say bullet one, this is the way it's going to go. I'll be satisfied. Maybe that's how I would expect that to be answered. But in just a general answer or in a clouded, it's very difficult for me to understand these two. It sounds just something that very abstract, So I just want assistance from the FFC, or even the PBO can also try to answer me as well around that question. I just want to understand from the FFC what is it that is a punitive condition for municipalities to can apply for debt relief? What sounds punitive in as far as conditions? Because my simple understanding was that we need to help you remove the debt, but you must also do likewise by complying with the conditions which are set for you to can be able to access that relief fund. But I don't understand what is punitive in doing that. Thirdly is on, I just want to check on both PBO and FFC. Have you done some research on reconfiguration of the department in the context that appears in the PBM medium policy statement as part of a long way to, you know, reduce duplication and save money, etc. Have you done such, or if you haven't, maybe it will be proper that such research must be undertaken to have, you know, information in advance in as far as that. On last, Chair, so I don't know, but my understanding is that I really do hear both presentations say something about fiscal consolidation, which does not really assist in moving forward. I want to get what is the, to what an extent does now the fiscal consolidation or MTBP policy has affected the economic recovery plan in general? Do you see to what an extent would it have impact would it have over it? Thank you very much, Chair.
Sorry, next is Mandela. Thanks very much, Chair.
Thank you, Chairperson. Okay, maybe my overarching greetings, everyone, great presentations and all. My overarching comments, Chair, go like this, that, you know, my understanding is that we're a Parliament of South Africa, Government of South Africa, but the whole discussion here seems to be focused not on South Africa, but on mainly public services, it were. And my problem here is that the biggest generator of the GDP in this country is the private sector. I think 75% of it. And to have this kind of presentation here with almost nothing being said about the private sector's contribution in all of this, it makes me very nervous, Chairperson. I'm not hearing what is being said to stimulate the economy and all of that. I hear the PBO is lamenting the issue of support to big corporates, but the PBO itself is saying nothing about small business and all of that. So I'm just nervous that we are just playing on the offside of the field, as it were, Chairperson. Then I've got just direct questions for the FFC, Chairperson. The first one, and by the way, Chairperson, on both these presentations, questions I'm going to ask are questions that I already covered to some extent, but I want to give these two agencies opportunity to expand and say a bit more on them. So it's not like you have not said anything on this thing. So firstly, FFC, can you provide more insight into the key areas of concern or priority in the medium-term budget policy that the FFC has identified, and how these may impact our nation's fiscal stability and economic growth? Secondly, this second question, Chairperson, it was actually going to be based on the NDP, if NDP was worth the paper it's written on. I hold a view that maybe the NDP should be thrown to the dustbin because it has missed everything. So I would have asked, what specific recommendations does FFC have for Parliament in terms of aligning budget policy with the NDP? But the NDP is a document that it really must go to the rubbish bin because it has missed all the targets, whether it's economic growth, it has missed, whether it's reduction of inequality, it has missed, whether it's improvement of employment, it has missed, whether it's increased gross fixed capital formation, it has missed, whether it's eradication of poverty, it has missed. So I'm nervous as to when the FFC makes this recommendation, what is the frame of reference? Because the NDP is totally useless. It's really worth rubbish bin, as it were. So what is your frame of reference? Don't tell me about NDP because that document is useless. Thirdly, could you elaborate on the expected consequences of the proposed budget allocations on various sectors of our economy? And what steps do you suggest we take as Parliament to ensure responsible fiscal management in the medium term? So those are the questions for the FFC chairperson. Maybe last two for them very briefly. The 2 billion, I mean, the minister mentioned something about 2 billion being borrowed every year, every day, basically, borrowings every day. Direct question, is this prudent? And all of that. And also this whole notion of these presidential envoys, cap in hand, going around asking for money and plunging the country into more debt. What is your comment on this? What are you saying to the president for all this cap in hand every day?
Mani, you're close to 4 minutes.
And all of that. Yeah, let me close the chairperson with PBO.
No, you
briefly.
can finish quickly, please. Another minute
okay.
or so. Yeah.
Another minute. Okay. All right. On PBO.
But we can come back to you at the end of the space. Everybody will have a chance.
You're taking my time, chairperson. On PBO.
No.
One,
it's not a fixed time. Yeah.
One, could you provide more details on the specific fiscal and financial risk you have identified in the medium term? You have mentioned a few. And what measures or adjustments you recommend to mitigate these risks? Number one. Number two, in your analysis, what impact does the proposed budget have on our long-term economic growth and sustainability? Are there any areas where you believe the budget falls short in addressing key national priorities? Lastly, how do the PBO's recommendations align with our country's broader fiscal and economic strategies? And what legislative or policy changes do you suggest to ensure responsible fiscal management over the medium term? Thank you, Chairperson.
All right, Mr. Mani, we owe you 32 seconds. So next time you can, next time you get a chair, we have remind them, okay? Now over then to, can we take the three chairs at the end so they can make overall comments as normally happens? So can we have Willie and then Noxie and then go to Chairperson Maswangani, and then it's Mr. Buthelezi and Ms. Mashlangu. Okay, so is that okay, fellow chairs? I don't hear any objection. All right, so can you go for it, Willie, and then Noxie, and then we come to the three chairs.
Thank you, Chairperson. Yeah, Chairperson, I want to start off by echoing what Dr. George said when he said that this is a manifestation of policy that's gone horribly wrong. We can see this in health and education and a few other items that grow lower than inflation, and that is due to higher debt service costs, which we have been warning about for many years now. Now, all indications are that every time that we get a presentation, things are adjusted to the negative. We rarely, if ever, get an indication that the forecasts were done right and that we will actually be in a better position that we forecasted. We are always in a poorer position. So the effects that this will have on education and health and actions where service delivery really has to take place will be higher and more detrimental to the man on the street, especially the poor. And we need to look into this. If you do not have money, you can't even buy toilet paper. That is as easy as that. But what we see every year is that with the we've got a downward revision of conditional grants, as well as the equitable share increases that are lower than inflation. That is due purely to high debt service cost, but in a large sense as well to the wage increases that we give to government employees. Now, isn't it maybe time that we take a firm stance on this? We heard in the past our previous ministers did not include wage increases into their budgets, but just to turn around at the end of the day and do it. We now see what effect that will have. Those people are already employed, but the fact that they need these exorbitant or these increases has got a hugely negative effect on service delivery for the poorest of the poor out there in our areas that does not even have a job if you look at the high unemployment rate. So my question is, isn't it maybe time that we follow the example set by the Tshwane mayor, where he said that there is just not money to give increases, and maybe rather spend that money on service delivery where people really, really require that. Another question from my side is, and it has been referred to quite a lot, the restructuring of tax benefit systems. What restructuring measures do you foresee must be in place? As I have been covered with regards to the VAT question that has been asked, but if you can give an indication of what restructuring you think that should be in place. With regard to municipal debt relief and the Eskom debt relief bill as well, you said, FFC, that you think that the punitive effects are harsh. And I would just like to know, do you agree with the proposed, as we did in the committee, the proposed ring fencing of money that municipalities will collect for electrical purposes? In actual fact, then let's say they get money in for a member of the public that pays his electrical bill. Do you believe that that money should firstly go towards paying Eskom, as not as a punitive measure, but as a measure that is a requirement for them to get the money that they owe to Eskom written off? Thank you very much, Chairperson. I think that I'm well in my 4 minutes. Thank you.
Yeah, 27 seconds more. Then there's Noxie, please.
Thank you, Chair. Thank you so much. Chair, let me appreciate the interventions that have been made by both FFC and PPO. They're really empowering. And my first comment really is to check whether they have not, as the two entities, thought of the wealth tax, because I'm yet to see a member saying that I am willing to give up my salary so that the economy of the country can grow. And therefore, whatever we wish others to do with their salaries, we should also be in a position to do it to our own. Because at the end of the day, what you earn is less than sufficient for what you owe. That's the story of life. Chair, I would like both FFC and, in fact, everything that I'm going to say, if they could comment on it. The first one is on the issue of cost containment. Whether this is timeous and what it is, therefore, that it will do to service delivery. Secondly, I'm interested also to know about what happens at local government level, because that is where ordinary people are. That is where the pinch of whatever the budget presents is felt. And what revenue measures can therefore be applied or tapped into when it comes to local government? And what are the required fiscal interventions on the distribution of non-interest expenditure to stimulate economic growth? Lastly, Chair, we have noted that National Treasury has stated that local investors are demanding higher premiums on debt, and the fact that most of our debt is domestic. What does this imply on the relationship of the state and the financial sector as these premium demands increase the debt to service costs? Thank you so much, Chair.
Thank you. Next, I see Fani's come on. Fani, you want to come quickly in?
Thank you, Chair. I've been here from the start, but I just raised my hand only now.
I didn't see it. Yeah, okay.
Honourable Chair, yes, something that wasn't covered in the presentation is the 300 million for the political party fund. And I'd like both FFC and the PBO to please comment on that and to tell us what justifies that amount and how exactly that will be used and utilised and what benefit that will have for the country. That'll be all for me. Thank you, Chair.
That was very brief. Okay, over to Chairperson Songani.
Thanks, Comrade Eunice.
I won't put on my video here. I'm using this Samsung phone. Thanks, and let me welcome the inputs by PBO and FFC. They have done lots of work to conduct the research in that regard. We have to appreciate the work that the researchers do. I think it should be corrected that this government has done a lot. As we speak today, 82% of the households have access to piped water, which was not there in 1994 when the ANC government took over. 94% of households today have got access to electricity. You will remember very well that before 1994, it will be the school principal there, the inspector, the chief, and so in the villages who were accessing electricity. But today, even a pensioner accesses electricity. So it will not be right that this ANC government hasn't done anything. And if you look at life expectancy, it has grown to 62.8%. And before 93, it was much lower. All these stats are contained in the Census 2022, which give an account of what the government has done from 96 up to 2022. So it will be important that honorable members should not just throw statements and which are not empirically verified, whereas there is an empirical evidence in the stats. And the government, like Gauteng, we have seen over the weekend, is intervening in terms of installing transformers. You saw the Premier installing the transformer there by Krugersdorp, Mohale City, and they will do more to continue to intervene in areas which were distressed, not having access to electricity. So my question would be, I think it's one, to a certain extent, even Honorable Kaiso has asked it, is that how we manage the debt. That debt is spiraling out of control. 2 or 3 so years ago, that was almost number 3 in terms of the budget items. But today it looks like it's going to be number 1, and it's going to put the credibility of government at stake. What is it concretely that FFC and PBO are recommending as to how we can deal with the debt? I heard them talking about structural reforms. What is it in the structural reform should government attend to deal with this problem of poor economic growth and managing debt, Chairperson? Thanks very much.
Comrade Sifiso.
Thank you, Chairperson. Thank you, co-chairs. Welcome the presentations by PPO and FFC. Can I just check, do we have National Treasury on the platform? Because most of the questions which are coming here, I think it needs their response, Chair.
Yeah, Chairperson, they're always here, and they note this, and remember they come back on this in the fiscal framework case on Friday, and then with appropriations when you raise specific issues. But if there's space, I think it's a good idea, Chair. We can give them 5 minutes to respond to some of the more specific issues to them. But you're absolutely right.
Thank you, Chair. Let me start by saying that as we discuss these issues, MTBPS, and what has happened over the years, let's not be oblivious of the fact that there were serious external shocks in the economy, which not just affected South Africa, but affected the whole world. COVID is one of them, which had a number of other negative implications. For instance, we introduced the SRD grant to try and deal with this thing. And there was a credit guarantee scheme which came on board again to try and deal with this shock. And recently, we're having the from last year, the Ukraine-Russia conflict, and now we've got the Israel-Palestine conflict. So all those things, they take all the numbers just out of balance. I just thought, let me preamble my presentation with that. First question, one of the FFC responsibilities is to advise municipalities about the debt. Some of them can even go to the market and raise money. So my question is, what is the indebtedness of the municipalities at the moment? Do we know it? Number two, we agree that the fiscal intervention by National Treasury should be and is temporal in terms of fiscal consolidation. The answer is inclusive economic growth. The question again, which has been asked by other colleagues, is where do you see growth coming from? That's both for FFC and PPO. Structural reform, I think Honorable Maswanga has spoken about that. Just to check, of the total debt service costs, what percentage of it will you attribute solely on the increase of interest rate over the past year or so? In that thing, two things would have contributed. The debt would have increased, but again, there's an element of that debt service cost which will be coming from the adjustment of the interest rate by the central bank. I just want to hear what percentage of that goes both to FFC and PPO. What do you think fiscal policy, trade policy, and monetary policy should do to assist economic growth and employment? You spoke about fragmented policies. What exactly are you referring to? I think that was FFC, but I think any one of you can answer that question, but the one up between you spoke about fragmented policies. So what do you think their impact should be? You talk about the cutting of conditional grants. I just want to check, what has been the performance over the years of the conditional grants that have been reduced? I will hypothesize and say they've been underperforming. And lastly, do you think the provinces and municipalities are focusing on their contribution to economic growth as a solution to the fiscal challenges that we are facing? I always get the impression that we all look at national government, but the role that should, at the end of the day, business happens at the local level. Do they understand their role as far as economic growth is concerned? Thank you, Chair. I tapped myself. Thank you.
Thank you, Honorable Chairperson. Let me also greet the co-chairpersons of different committees members, Team FFC and Team PBO, and the colleagues on the platform. Chairperson, I'll also join my colleagues by welcoming the well-researched presentation by both FFC and PBO. And I'm raising these issues that I want to raise, mostly covered by other members. I will not go there, but I understand that you might not have the expected answer that we might be expecting because you are not Treasury, but we understand your role, that you are here to give your research, your analysis, to empower us and also give us your view. And I think also in raising these things that we want to raise, you will further empower us. Several members have spoken about the Special Relief Fund, and I don't know, pardon my ignorance if you might have spoken about it in that regard. As this committee, I'm speaking, I think, jointly and also as the Select Committee on Appropriations from the NCOP. We have had discussions and recommendations, welcomed this positive step by the government in terms of responding to the challenges that we were facing. But we have had recommendations What is your view, both FFC and PBO, in terms of the sustainability and the plan as pronounced by the treasurer, by the minister? I've heard when we had engagements last week, some of the members they even suggested that it must be renamed. The name of the relief must be changed. It should be something permanent. But all the same, even ourselves, as we recommended, we ask the same question: where will the money come from? And the more pressure we put when the government respond, it will have no choice but to go and borrow, and our debt will not be improving. And we don't want to see ourselves as a country having huge debts as a country. We want to get out of that situation, even though we know that it's not the new debts, we have inherited them. So we also raised something, Honorable Chairperson, which we have been consistent about, and together with FFC, we have raised it and agreed as a committee. Is there an improvement? This one is directed to FFC. Is there an improvement in terms of your recommendations or your advices that you give to National Treasury? Because initially we were informed or we became aware that through our engagements that the Treasury seemed not to be taking your recommendations into consideration. So do you have a better relationship now? Do they take your recommendations? Do you have engagements? And I think someone has raised that. The last one, Chair, is the issue of the merging of the SOEs. I want to know from both PBO and FFC, what is your take? You know, when we talk about merging, myself as an individual, I'm a bit disturbed because it's a good thing because we want to resolve an issue, but sometimes you'll have unintended consequences, because we know restructuring are problematic. What is your take? Do you think there will be job losses? Because with the experience that one had previously, where there's restructuring, there will be job losses. But we're not saying they should not be done. I think consultations have been made. That's what I want to believe. I didn't hear it from anywhere. But because you have made this research yourself and you have had engagements with the National Treasury, they might have had a plan to say, when we do restructuring, we know these are the things that are going to affect the employees. And we know the level of unemployment as per your presentations, that South Africa, we have a high level of unemployment. So we can't really increase that percentage. That's my take. Thank you very much, Chairperson Karen.
Thank you. Just really quickly, we're running out of time, so I won't raise my questions all, of course. Firstly, a quick one to the FFC. If you have the time, reply. Otherwise, you can send a short reply by writing. How would, you said that you can have a progressive tax regime for small businesses. Many of us get accosted by small business people who complain bitterly, right? So that'll be interesting. What are the elements of that? 3 things you can think of. 2 is, I like what Busi Sebeko said about tax not being a source of raising money alone. It can steer the economy in particular ways. I think what she was saying, production and so on. I really like that. And we need to look more carefully at what she's saying. Finally, I think, as I think most of us do, that yes, the SOEs are challenged. Even the peasants in Outer Mongolia know that, but you can't give them up. Oh, please, we can have various forms of partnerships, public-private partnerships and the like, but the public-private partnerships must be weighted in the interests of the public sector, the state, the people. I mean, you can't give up to the private sector water or electricity or transport and basic needs like that. But we can have partnerships, the variety of partnerships we can have with the private sector without foregoing ultimate state responsibility. The rest I'll forego. Over then to the two entities, we've got about 32 minutes. So I think 15 minutes each. Now, I must say, comrades and colleagues, we need to review the way we do this, because what happens is the questions are so complex and so good, I don't know how they're going to reply in 15 minutes. So we need to review how we do this thing, but I'll come back to that at the end for a minute or two. But for now, let's hand over to you 15 minutes each, and then you'll send us questions, answers in writing within 48 hours, please. And you'll be direct and pithy and precise in your responses, because the questions are very, very good. It's impossible for you to reply to them in 15 minutes each. Thank you. So the FFC, please. Yeah, let's go for the FFC quickly.
Okay, thank you so much, Chairperson. We'll go first. Thank you so much to all the honorable members for the questions. I think I'll take a few, Chairperson, and then I'll ask my team, commissioners who are on the platform, as well as the researchers, to get into some of the questions. If we can't, we'll also respond in writing. Honorable Moletsane, with regards to the local government fiscal framework, we are at a technical level working within the finance team to review that, and we also looking at all the other data sources that will enable us to do a complete review. We are mindful of the fact that the 1998 white paper on local government, the assumptions thereof almost 30 years later have not really come into fruition. So we need now to go back to the drawing board and review the expectations of how that paper viewed how local government will function. So we are working with the teams on that at a technical level. Maybe I'll attempt to answer some of the questions around fiscal consolidation, but I think some of the economists in our team will answer that. So when it comes to fiscal consolidation, we know that in many countries right now, that policy agenda is currently implemented, given to the COVID-19 pandemic spending that actually created a lot of fiscal deficits, and hence the public debt was quite high. So when it comes to fiscal consolidation, essentially the goal is to reduce the fiscal deficit and to reduce the public debt. There are essentially two ways to go about it. Either you reduce your public spending, or you do a tax hike. In the short run, when you do the fiscal consolidation, you implement that, there are going to be some shocks in the system, in the sense that there will be some output losses. There can be loss of employment. There can be worsening income distribution in the short run. That can happen. But in the long run, the idea is that the debt position of the country can be stable. But then it depends, what is the long run? The great economist, John Maynard Keynes, said that in the long run, we are all dead. But in the short run, we will have pain in the sense that we will have losses. We can have output losses. We can have worsening inequality. But the idea is that in the short run, we expect that the public debt can be stabilized. So it is a policy mix that the country must look at how do we actually achieve this? The reality is that there are no quick losses or quick gains. The reality is that in the short run, we could experience a lot of inequality in the system. We can experience a lot of income inequality and job losses, but we can achieve, if we are prudent, we can achieve debt stability. But in the long run, the idea is that the economy will be back on the stable growth path. But the idea is that in the long run, where are we in the long run? Some of us will not be here. So what is the long run, essentially? And then the other question with regards to the recommendations of the Financial and Fiscal Commission, there is essentially nothing wrong or nothing lacking with the recommendations of the Financial and Fiscal Commission. The recommendations are evidence-based, they are very cogent, they are very rigorous, they actually touch on all the key issues. The question that we as the Commission are grappling with is the fact that not all the recommendations are accepted by the Minister of Finance. Why? Because some of the recommendations do not speak directly to the Division of Revenue Bill. In terms of the Division of Revenue Bill, the Minister only looks at those specific recommendations which speak to that bill. A lot of our recommendations in the last few years have actually focused on many important policy issues which have an impact on financial and fiscal matters and actually have an impact on the budget. But because they do not directly speak to the Division of Revenue Bill, they are sort of not properly processed by government. So as the FFC, we are looking into how do we engage cabinet, which has all the ministers and the executives in the executive who actually have oversight on those policy issues. How do we engage them to ensure those policy recommendations do not fall through the cracks? But the bottom line is that all the recommendations of the Financial and Fiscal Commission should be accepted by government in their entirety because they speak to all financial and fiscal matters. I would like now to find out if my Commissioner Rockman has any comments or thoughts in any of these matters. If she does, she can comment. And then I would like to hand over to some of the researchers to also take us through that. If there's not enough time, we can also respond to all the questions in writing. Thank you so much. Over to you, Commissioner Rockman.
Thank you, Chairperson. Just briefly, two issues. The one on the provincial wage bill. I think it is unavoidable that provinces will have to look at three factors: the post-traditional to establishment, the employment out of adjustment, and the implementation of occupation-specific dispensation to try to control or reduce expenditure. The deficit currently on the wage bill will not be found in provinces, so it will be an escalating challenge. And then secondly, there was a question on the 300 million towards the political party fund. I think it's never a popular subject, but the functionality of our political parties are critical to the health of our democracy. And to enable political parties to function and to at least cover their basic needs, and also to enable them to engage with their constituents, to enable a vibrant democracy and public participation. I think that funding is justified. There will always be a debate around the amount of the funding. From a political party perspective, it will never be enough, and from other perspectives, it will always be too much. But it is an unavoidable part of supporting democracy. Thank you.
Thank you so much, Commissioner Rockman. Mr. Jonas, Tando, and also Sasha, if there are any thoughts on your side on any of the matters.
there is nothing on my side, Chair, except just to say one thing, that in terms of fiscal consolidation, for us not to experience deeper cuts in terms of our spending, we have to actually grow. And that growth, where will it come from? I think most of the growth can come from supporting an export-orientated, productive economy that focuses on trying to export that then requires fixing of the rail infrastructure that has hindered growth and hindered our ability to export more as it relates to Transnet. So that is what I can say for now. Thank you.
Thank you so much. Thando, any thoughts on your side or not? And then Sasha as well, and then we can hand over to the other, to PBO.
No, thank you, Chair. Shortly, just to add on what you've already said regarding fiscal consolidation. So we see fiscal consolidation as critical for the country, given where we are in terms of our debt, like you were saying, our debt, government debt, and the fiscal deficit. So it's important to institute a fiscal consolidation exercise that will stabilize public finances, because by doing that, then you are laying a foundation for economic growth. And we unpack in our presentation the relationship of the condition of doing that being the primary surplus, and the relationship between growth and interest rate. And we're saying as long as you have real interest rate that is greater than growth, you have a problem in terms of stabilizing growth. But the most important thing to us is to institute a pro-growth fiscal consolidation that will take into consideration also the growth prospects, because otherwise, if you are instituting fiscal consolidation on its own, austerity measures, like we said in the presentation, on their own, they will not help us. But what we have to do then is look at the other variable in the equation, which is economic growth. How do you balance the two? Institute a fiscal consolidation exercise, but also in a way that enhances growth. That's the part that we want to emphasize. And then secondly, just briefly on the tax proposals, we are saying that effectively there is little room to increase the rates per se, in whatever category you're looking, whether it's especially with personal income tax, and the other tax categories. Yes, we're saying if you really have to go the route of increasing rates, then you must also increase those taxes that enhances growth, not those that are going to damage growth. So if you are looking at VAT increases, it will be in line with growth considerations. But the focus, as we say, at this particular point in time, is just to look at the tax benefits. How do you institute reforms that are going to make sure that the current regime of benefits are streamlined to improve growth? And then secondly, how do you make sure that they support growth in the way that they are being instituted? So in terms of the tax proposal, we are saying basically that we are not looking at the increase in the tax rate, but just instituting reforms that are going to make sure that the tax policies also support growth. Let me end the chairperson and hand over to Sasha if she wants to add anything. Thanks.
Thank you, Thando. Just three quick inputs. With respect to the Eskom debt relief to municipalities, We agree with the initiative and we agree with the fact that there should be conditions. But the condition that we think is punitive is the one that relates to taking over the electricity function from municipalities if they fail to meet the conditions. We find that to be quite severe. The fact that municipalities are requesting debt relief in the first place means that they are under pressure. So to further take away a function and one of the more important revenue-raising streams from a municipality will put them under more pressure. In addition, municipalities are allocated the power to distribute electricity via the Constitution, so it's not really as easy as just giving over a function. But I think the key thing here is that any approach to solving this must have the municipal sustainability at its core. So it shouldn't further cripple a municipality. Then to Honourable Abraham, we have done some research on supplementary revenue sources for municipalities, and we can share that. But essentially, we in that research, we had recommended differentiated revenue sources for the different categories of municipalities. But it should also be noted that there are constraints to levying supplementary revenue sources, and this includes the fact that there is an onerous approval process, and if there's lack of political will or lack of capacity, it doesn't get approved. And then the question on the indebtedness of municipalities. Overall, municipalities owed creditors 100 billion as at June 2023. Thank you, Chair.
Thank you so much.
15 minutes.
Over to you, Chair.
Thank you. Splendid in managing your time. Thank you very much. We'll get written answers from you over the next 48 hours further. Okay, over to you, Dr. Junket.
Thank you so much, Chair. Thank you, members and colleagues, for the questions. I agree with you, Chair. Can you hear me? Okay, yes.
Yeah, we can hear you.
Thank you so much. I agree. They're really quality questions, and we really appreciate the questions. I think some of them will definitely want to do them in writing. I'll respond some of the few pointers, and I'll ask my team to come in as well. I think just before I answer the question, just so I emphasize that we generally don't take position on policy, government policy, but I think our approach is to advise Parliament in terms of what the impact of this policy on the macroeconomic conditions, on the societal conditions, and also for public finance conditions. That's really our approach in this regard. I think I want to start with a general message. So our general message here, Chair and members, is that the evidence does show that we have done quite little in improving our development indicators as set out in the NDP and other measures that are put out by government. And I think our emphasis is to say it's clear from the past decade or so that the fiscal stance we've taken over time has largely contributed to the slow progress in realizing these development indicators, improving development indicators, unemployment, employment growth, and so many other things. And also it has worsened of that. Even before COVID-19, Chair, you'd realize that there were all these measures already reflecting quite strongly. And here's our view that continue with this stance will worsen off the conditions over time. I think that's a message that we're putting out there. Very clear evidence that we've seen underinvestment, and that led to unemployment and also low economic growth in that regard. I led the team in economics class to talk to that quite more substantively. The question of before I move to tax, there's a lot of discussion on tax policy. The question on the public debt, I think one of the issues that we did, I think, highlight in our pre-brief document is also, debt is not only a expenditure problem. It's very important to recognize. I think that's a message you're trying to put out a lot in what we've been saying, but it's also a growth problem. And our view is that, one of the strategies to deal with debt is to grow the economy. And that's really our emphasis. And also the fact that the interest rate, the higher the interest rate and the lower the growth, automatically going to have high debt, regardless whatever cut of expenditure we make. So clearly, the mix between the interest rate and growth will lead to higher debt, regardless of how much cutting of expenditure we do. So our emphasis, therefore, Chair, is to say we need to really grow the economy, and we worried or concerned that the current strategy will actually worsen or if it leads to lower growth and worsen of the debt levels in that regard. The issue of state-owned entity, it's a very interesting issue in our view, but also that what we have seen, even in the literature, does show that the role of the state-owned entities is largely to deal with market failures. And we have seen examples around the world. We've written a paper a lot around this. And that doesn't really justify the poor governance, the poor corruption, and so many. And our view is that those issues have to be addressed. Poor governance, having proper people appointed in these entities, and proper leadership and sustainability leadership in these state-owned entities. But I think the goal objective of it should also remain to deal with market failures. But the other point that I want to emphasize around SOEs, Chair and members, is that a lot of the problems that many of these SOEs are facing now, it's really an issue of huge underinvestment in this entity. You remember ESCOM, one of the previous former president did raise raise concern that failure to invest has led to ESCOM challenges and so on. And we see the similar trend playing out in Transnet as well, and so on. So what we're saying, we need to separate the issues, but the issue of investment and ensuring these entities deal with the developmental objective as set out to be, we need to ensure that they deal with that. But maybe there has to be better linkage between the role of these entities and industrial policy as is put out. And I wish that we should have a separate session where we have a broad discussion around industrial policy and how much the macroeconomic policy are hindering industrialization in our economy. The issue of the taxes. I mean, taxes comes in later in the discussion. And I think in our previous discussion, we have raised concerns, or we actually made recommendations to say, look, there has always been spaces, as Wilson noted, that where government could have raised taxes revenue even previously, and that hasn't happened. And I think that has to be really taken into account to say there are what I would say hanging fruits in our view. The issue of windfall. I mean, one example we've made in our brainstorm is around how much financial assets have increased value as a result of the interest rates increases, and that led to more profitability in the financial sector. But also looking at energy sectors, higher fuel, higher, so that led to more profitability, where even the Secretary General of UN has raised concern, why are we imposing more taxes, windfall taxes on these big sectors that are benefited from the challenge that we have, the political challenge that we have as society, and that we have not seen. And I think in our view, there's still strong spaces in that regard. The issue of VAT, generally in the literature, VAT is a regressive tax, meaning in a sense that affects more households than it affects the well-off, and any consideration around should really take into account that. And we have not seen much of support earlier in the 2018, and government actually promised to come back to revert back. But the consideration is that this likely worse off poverty, but also VAT is more inflationary when we get VAT and other measures thereof. So think around which measures. Definitely VAT will probably have to be the last consideration out of all the tax instruments that we have. The issue of wealth tax is an important consideration. And I remember very well that previously the Commissioner of SARS had noted that they're currently collecting information around wealth in our society. And that, in my view, there is an opportune time now to come and update Parliament how much information has been gathered and viability of wealth tax. Evidence shows there's a space for wealth tax in our economy. That needs to be decision taken to impose wealth taxes in our economy. And that should be one of the areas that is taken into account or consideration in additional revenue we need to collect. And lastly, on tax, the issue of tax expenditures. We've raised this before. Some of the tax expenditures have not really led to the outcomes that we set them out to be. We had a lot of argument around employment tax incentives. We had a lot of argument about some of the long-standing tax expenditures that have not led to a desired outcome. And I think that's a space that we should also play into that space. I'll leave the 27%, 28% for government to respond to that question. Last point for our Gideon team is around SRD. In my view and our team's view, it's one of the important policy interventions in our view, which was put out by government and has really showed strong evidence that it was important to intervene in that regard. And I think that's one policy that government was going to also really see it has been a very important intervention indeed. And in our brief last year or 2 years ago, we have said there has to be very consideration that such mechanisms should form part of economic planning, having support to households, unemployed people, and so on, has to be considered in that context, that you have a permanent measure that support household within that or the poor within that perspective. And that, Chair and members, has to be seen as part of supporting economic activities, because that has the potential to lead to industrialization, but also more economic activities, but also has the potential to raise more revenue for state as well. So this support household should not be seen in one-sided. As much as it support household and lead to less malnutrition and so on, but it's also an economic activity which leads to more growth, could lead to more investment, but also could lead to government revenue created within that context. Chair, I'll stop there and I'll let Dr. Olandi come in and Dr. Siraj, and then we'll see if there's anything outstanding. Thank you so much. Dr. Olandi, do you want to come in? Thank you so much, Chair and members.
I think Siraj can go first.
Dr. Mohammed, do you want to come in?
Yes, please. Okay, my video has also come on. Thank you very much. I think the main issue I want to deal with, and I'll try and answer some of the other questions too, dealing with this question, is the question asked by Honorable Kayiso about how does fiscal consolidation enable GDP growth? And I think that's a really important question to ask. And he asked that we explain it to him. And I mean, a lot of fiscal consolidation by the South African government and governments around the world and the move towards austerity have been informed by this. And so how the supporters of fiscal consolidation argue in favor of it, there are two ways. The one is that if government cuts its spending and reduces its deficit and brings down its debt to a level that seems acceptable to especially to the private sector, and here it's often the credit ratings agencies and the big banks and other financiers, then it will increase the credibility of government, and business will feel more, their sentiment will improve, and then they'll go and they'll invest more into the economy. And clearly that is a really false premise. That has not happened. It hasn't happened anywhere around the world. And in fact, it's shown that, as I put, the quotes I put up, is that fiscal consolidation leads to lower levels of growth. It leads to lower levels of demand within economies. And demand is what drives economic growth. And so you can try and also the nature of big business, particularly those that control a lot of the economy, and the choices they made and how internationalized they become and how financialized they become, often means that when they do get profits, or even as we showed in our slides, when they do borrow more, or when the private sector borrows more, they don't necessarily put that into long-term fixed productive investments. They'd rather keep their shareholders happy with the big dividends in the short term and basically look for high short-term returns. The second way that it's supposed to support growth is that there's this argument that when government borrows a lot, there's a limited amount of money to lend, and so they're crowding out private investors. And now what we've shown is that when we've extended a huge amount of debt as a percentage of GDP to private investors, but they haven't actually invested it in job creation, in long-term productive areas of the economy. And so what we're arguing is that over the past decade of fiscal consolidation, basically they've proven this view, and with linked to the point that Honorable Buthelezi was making about the shocks that's happened to the economy, in terms of, I can start with the global financial crisis and then with COVID, and now we're seeing increasing climate change and geopolitical stresses that we face. I think what especially in developed countries, where we've seen is that after the global financial crisis, they moved towards using monetary policy, lowering interest rates, taking control of the value of the interest rates and the currency into the state institutions like the central bank, but also by the time of COVID, deciding that they are going to directly use fiscal stimulus much more. And so what we're seeing is this shift in a mainstream consensus around fiscal policy and its how impactful it is, but also the necessity of building resilience. And if you look at what's happened in the US, I mean, they're basically spending $3 trillion into providing, they had spent with the Inflation Reduction Act, into providing households with more money, and also in infrastructure investment and moving towards renewables and green investments. And we saw in the last quarter 4.9% economic growth in the US, despite the higher.
Suraj, sorry, man.
Okay, sorry. I know
You're
this
about
is
13.5 minutes as a
shall
whole.
I?
So
Yeah. Okay. Maybe I should move
yeah,
on
but I
to
mean, we're not going to be
Lilia.
mechanical.
She wants
Give it
to.
extra 3 minutes or so, but I'm not sure who else wants to speak. That's for Dumasani to decide how to manage
Yeah.
it.
Okay.
But Dumasani, you're
I
at
think
about
maybe I've
13,
answered the
almost 40
question
minutes.
about fiscal consolidation, and I'll pass on to Lilia then. Sorry for going into
No,
lecture.
it's fine. It's us must apologize. We need to restructure the way we do this, which is what I want to suggest at the end. I'm really sorry, Suraj, because it's very good replies. But say it in writing, please.
Yes.
We really do read the stuff, and when we shape the reports, we look at everything that they're said in writing as well. Sorry about that. Okay, over to the next
I'll
person,
summarize
please.
what I said in writing. Thank you, Honorable Karim.
Please do. Yeah.
Busi, do you want to come in or Tsepo? Colleagues, are you? Delia, do you want... Who's coming in? Are we done? Okay, Busi, go ahead.
I think most of the questions have been done. Just wanted to respond re the corporate income tax. There hasn't been a study done, at least as far as we know, at least publicly published. But I think this speaks to the broader question of monitoring and evaluation of tax policy changes. When a National Treasury introduced the VAT increase, they had said that they would conduct a monitoring and evaluation 3 years later, which actually connects to some of the other questions about VAT increases, is that we don't even have a publicly available, at least monitoring and evaluation paper on the impacts of VAT on the majority of South Africans. And so, as our director has already said, it is a regressive policy generally. But since the increase, the 1% increase, we also don't have that. I think in terms of just taxes broadly, we need to think about effective tax rates. So when thinking about how to restructure the tax system, it's actually saying if there's an incentive here and there's support here and there's a tax here, what do companies and people actually pay at the end of the day? So yes, the statutory rate is 27%, but it doesn't mean that companies actually pay 27%. And so when thinking about our tax system, we need to broadly think about how the different policies are interacting and therefore how much people actually pay in terms of tax. And that includes, of course, if we think about wealth tax, property tax can be considered a part of a wealth tax. So we would have to discuss whether we need a net wealth tax or whether it means increasing certain taxes that would be considered wealth, capital gains tax and so forth. And in terms of the commodity prices, I think Treasury was aware that the commodity boom wasn't going to last very long, but of course it's hard to project. So, we also understand from a Treasury part, it's hard to project how long the commodity boom will last. I think this is where the PBO proposes a windfall tax, because what we could have been doing is taxing the excess profits, so then we'd have a smoother, revenue recovery or have more revenue after the commodity boom itself.
Thank you so much. I don't know if there's other colleagues. Nelia, are you okay? I think our time is up. The last point, Chair, I just wanted to... Oh, Tsepo, do you want to come in? Come in, Tsepo.
Can you hear me?
Quickly, Tsepo, thanks.
Thank you very much. I'll be quite brief. I think seeing that there's a number of questions on debt, and there seems to be this fear about debt rather than the impact that the budget reductions will have on the most vulnerable in society. But I think Honorable Buthelezi also asked the question about the higher premium and the structure of our debt service costs. In this regard, I think we are planning on writing a brief on these particular matters. But I think briefly, we do know that our debt service costs are influenced by both interest rate increases as well as the debt stock. 90% of our debt is denominated in rands, and therefore higher interest rates by the SAP impacts the entire economy, including the South African government's debts. So we've argued on several occasions that high interest rates are a blunt instrument to employ, especially if much of your inflation is driven by supply side factors like the war in Ukraine, etc. And therefore, increasing interest rates in the current environment is not effective in terms of bringing down inflation. But as I conclude, I would say that this whole debt interest rate nexus also speaks to the lack of monetary and fiscal policy coordination between the National Treasury and the SAP, because on one end, the SAP is more obsessed about inflation, while the Treasury is just focusing on debt. Neither of the two want to take responsibility around economic growth and employment. I'll leave it there. Thank you, Chair.
Thank you so much, Sepo. Nelia, just come in there.
I'm covered, Dumisani.
Right. Thank you so much. I think, Chair, the last point at which I left before I give it back to you is around the issue of private sector. I think one of the messages that we're making also, Chair and members, is that a government investment economy actually crowds in private sector, because when you build infrastructure, it's a private sector that actually build this infrastructure. So that has to also be seen as a role of government, bringing in private sectors into participate in economic growth. And that aspect has to also be recognized, that by investing in the economy, you are actually crowding in private sector into the space. The issue of SMMEs, Chair and members, is really around localization issue. And the public procurement is a very important aspect in our view to really ensure that small, medium enterprises are able to get contracts from localized areas, but also the issue of support to small enterprises, a very important issue which we'll discuss separately. Chair, thank you so much, and members, for the opportunity in this regard. Thank you.
Yeah, thank you very much. We're slightly 3 minutes over time. Look, very quickly, especially addressed to the chairs, but also all of us, as we exit this term, we need to review, colleagues, how we do this process. Obviously, 3 hours are not enough. Maybe there are options that just go through my head. Co-chairs, I mean, I don't know. But maybe in our exit reports, maybe the 4 of us should meet and call meetings of our respective committees or together and look at a way of dealing with this. Because most questions were not answered. And yet they were very good questions. So the one thing is maybe reducing the time given to members. Instead of asking 8 questions and getting an answer to 2, maybe it's better to ask 4 and get an answer to 3. I don't know. Or maybe we split it up. They come in twice, once for the fiscal framework, once for the appropriations. Or we have 2 sessions. But 1 session clearly is not enough. And I must say, comrades, chairs, to fellow chairs, I really think this was an unusually good exchange. And it's a great pity we don't have more time. But also, we must remember at the end of this quarter, we have just about a month left, especially on the NCOP side, with both committees having the same members. We get lumbered with a lot of work. So we need to look at all of these things before we exit. But I want to apologize on behalf of, whoever, I don't know, apologize on my own behalf, that we didn't do enough to engage, that members were asked to stop when they were in mid-sentence. So it applied to the FFC and PBO. We can't carry on like this. Let's look in whoever's coming back in the new term and new ways of dealing with these issues as the MTBPS becomes more and more challenging and complex. So that's my little penny's worth, halfpenny's worth. Comrade Chair, Joe, do you want to say anything, please, as we conclude? Joe?
As you have suggested that we can create space as chairpersons to discuss how we program a session like this. I think I buy your suggestion. Let's create that space at some time and see how we can properly program. Because this session is quite very important. It's dealing with the critical matter of the budget and the interest of the country. Thanks very much, Chairperson, Comrade Karim, and co-chairpersons and colleagues in general.
The other chairs, do you want to add anything? So, Lady?
Yes, Chair. I agree with the marching orders as put by yourself.
Marching orders, they're questions. But never mind, you from MK, I understand.
and Honorable and Honorable Joe. In the meantime, can we ask PBO and FFC to please attend to the questions in writing and give to us? I know that they've got answers to these things and suggestions. Thank you, Chair. Thank you.
Absolutely right. Then who's left? Dikeledi, please.
Yeah, Chair, I agree that amongst ourselves as co-chairpersons, let's have discussion and pave a way forward. And correctly said by you, from the NCOP side, we are 2 in 1 and we don't have much time. So we will discuss it there. I am covered by what other members have said. Thank you very much.
Thank you very much. I take it Dion George doesn't object. We can have that discussion in North Korea over Christmas. Thank you very much.
I don't object. I was struggling to log in all the time. I'm not objecting to anything, and I missed all of you.
Who would this be?
It's Tandy Tobias.
I can
see. The chief of life for finance. Oh, I see. Thanks, Tandy. Lovely to hear you. Yeah. Okay, keep well, everybody. Thanks, comrades, especially the cooperation of PBO and FFC. That was great. You really handled the meeting very well. Thank you so much.
Comrade Chair, can you please give time frame for the responses?
48 hours, we said. Is that okay?
Yeah, it's
because
fine.
They have the answers. Yeah, they
Tandy,
have the answers.
Can you open your video, please?
Tandy, we want to see you, man. Look how overpopular you are. You're overshadowing me too.
I'm known.
You are known. Okay. And you are sorely. You see, the chairperson, Joe, hasn't had the opportunity to be in the same committee as you. We do, right, Dikeledi and I. So we know what he and his committee are missing out on. Okay. And I think Sifiso knows, of course, yes. All right, can we draw to a close, colleagues? We all have different responsibilities emerging almost immediately. Thank you. Thank you all for your cooperation. Bye then.
Thank you, Chair.
Bye.
Thanks, Chair.
Long live the Chair. Thank you, Chair. Nombula, my phone is frozen. Lelo.